세미나 곧 시작하겠사오니 밖에 계신 분 들어가시면 감사하겠습니다. 네, 그럼 지금부터 코로나19 이후 세계 경제 조망과 한국 경제의 시사점을 주제로 한 한국금융연구원
We will now begin the international conference for the 30th anniversary of the KIF. I am Iseok Ko, who will be moderating over the opening session. Before we begin the plenary sessions, I would like to invite President Jong-kyu Park of KIF for his opening remarks.
안녕하십니까. 한국금융연구원 원장 박종규입니다. 오늘 저희 연구원이 주최하는 창립 30주년 기념 국제 컨퍼런스
I would like to welcome all of you to 2021 KIF International Conference titled Prospects for the Global Economy After COVID-19 Implications for Korea. Thank you very much for joining us despite the rainy weather outside and despite the early hours. I would also like to extend my deep gratitude to the Chairman of Financial Services Commission, Ko Seung-bom, who will be sharing with us his congratulatory remarks online. We have with us the organizers of today's event, Professor Park Young-chul, who is the second president of our institute. He has also co-authored the presentations with Professor Thorsten Beck. I would also like to thank all of our foreign speakers as well as discussants who have taken time out of their very busy schedules. And despite the time lag, thank you very much for joining us. I would also like to thank all the online participants as well. In 2021, January the 19th, we had the first COVID patients, and since then it's been about 2 years. Looking back, not just in Korea, but around the world, there were a lot of sacrifices, and we have suffered quite greatly in terms of our daily lives and in the respective countries' economies. In order to overcome these challenges, many countries around the world have implemented many different measures. In the response to COVID-19, there were excessive liquidity, which led to asset price bubbles, and this has also recently triggered concerns over inflationary pressure. Including Korea and in the United States, there are talks of tapering and hike in increasing the interest rate, and in the process of normalizing the monetary policies, there may be higher possibility for greater uncertainties in economy and financial market in EM countries. Also, if you look at Korea, we have the high level of household debt and surge in housing prices, which has become a very imminent issue. If you look at INEAD, which is the in the ancient Roman poet Virgilius has written, INEAS actually visits a underground world, and when INEAS meets Hume Civil, he asks the following question: it's easy to go down to the underground world. The door to death is widely open. The descent to the underworld is easy. Night and day, the gates of shadowy death stand up open wide. But to retrace your steps, to climb back up to the upper air, there the struggle, there the labor lies. I believe that bringing down the interest rate in crisis and expanding liquidity may be quite easy. However, in the process of normalizing the low interest rate and absorbing the excessive liquidity, there will be a lot of risks and difficulties. And that is what we have learned over the past century of economic crisis. I believe that each country will prove its capabilities through its economic policies in the process of normalizing their interest rate and liquidity policies that they have implemented so far. On the other hand, we have seen constraints in the global supply chain, and we are seeing spread of the hegemonic rivalry between the U.S. and China and the growth of protectionism. Regionalism and nationalism is also deepening, and at the same time, with greater expectations and need for convenience and contact-free demand, we see an emergence of big tech companies. They are currently competing fiercely to gain an upper hand in the financial market. I believe that going forward, we will see greater spotlight placed on the international monetary order and the changes and transformation in the global financial market, as well as digitalization. I believe one of the key challenges that most of the countries and economic entities will face will include issues such as climate change, aging society, and economic inequality or polarization. And these have been included as the topics for sessions 1 and sessions 2. I hope that today we would not just take stock of what had happened in the past, but I hope that this will provide a good venue for us to share our wisdom in identifying countermeasures going forward in the face of the uncertainties that we face post-COVID-19. Cheyenne is a tribe in the American Indian. They have said the danger foreseen is half avoided. I believe that it will not be easy for us to identify such difficult challenges ahead. However, if we are able to effectively identify those risks, I hope that today will provide a good stepping stone for us and a good opportunity for us to identify those big challenges coming our way. Once again, I would like to extend my deep gratitude to all our participants, both online and offline. Thank you.
Thank you very much, President Park. And now we would like to invite online Chairman Seung-Bum Ko of FSC. He would like to deliver his words of congratulation. Hello, everyone. I am Seung-Bum Ko of FSC. I would like to congratulate the 30th anniversary of KIF. The KIF is Korea's first financial research institution in 1991. It started with 6 members, and after that, for 30 years, it has led the development of the financial industry by presenting visions and directions for financial policies, and it has grown into the largest and most renowned think tank in the finance. I would like to thank the researchers and President Jong-kyu Park and all the previous presidents for their hard work. On commemorating the 30th anniversary, you're having the International Conference 2021, and there are many scholars from home and abroad who will make this event more meaningful. I'd like to congratulate you all. 30 years ago, if you look back on the financial industry of Korea, it was not possible for foreign ownership of shares, and the real name transaction had just started, and the liberalization of financial market had started back then, and with that, the Korean financial industry changed. The Asian financial crisis in 1997, the GFC in 2008, the credit card issues, and the COVID-19, there have been many disruptions. But despite all, the KIF was able to hold its position. The financial authorities and the academia had engaged in diverse collaboration and research, and the KIF served as the compass presenting the direction. And as one of the persons in the financial sector, I would like to thank the KIF for its hard work. But it cannot be complacent. For the last 2 years, because of COVID-19, the situations in the economy and the finance has presented us with many challenges. The COVID-19 pandemic has affected consumption and investment. They have contracted, and the small merchants and the small businesses have been hard hit. And thanks to the understanding and cooperation of the people for vaccination policies and the government's aggressive policies, the economy was able to stabilize, and we are able to minimize the downside of the COVID-19. But it does not mean that we can go back to the pre-COVID normal days. We have the non-face-to-face contacts, and we have the fourth industrial revolution, which are affecting our lives. And the unprecedented economic shocks have hurt us, and the vulnerable class and the marginalized have been hard hit. And we have to close the gap. In responding to the COVID-19, the financial imbalances, such as the excessive liquidity in the market and unstable assets, are some of the potential risks to be resolved. And so, alongside the challenges, the KIF should lead in looking for the solutions. If the financial industry is shaken at the root, the real economy cannot grow in a stable manner. And so it should monitor the internal and external changes in the market and present us with the right directions. And I hope that there will be active academic exchanges so that the KIF can position itself as an even better and bigger think tank. We have invited top scholars from home and abroad. I hope there will be constructive discussions, and the FSC will take heed and will provide a sound basis so that the financial industry can become a leading industry in the future. Once again, I would like to congratulate the 30th anniversary of the KIF, and for a better finance, I wish you success. Thank you very much.
예, 감사합니다.
Thank you very much. Before we move on to the first session, we will reorganize the podium, and we will begin in 9:10. Thank you.
이제 곧 시작하도록 하겠습니다.
We will begin.
예, 그럼 지금부터 오늘 컨퍼런스에
We will now begin session 1 of the conference.
프로페서 솔튼백 교수님께
We have Professor Thorsten Beck who will be presenting first.
Okay, good morning, and thank you very much for giving me the opportunity to talk to you today. I'm very grateful to the Korea Institute of Finance for this opportunity, and of course, I'm sorry that I cannot be in Seoul myself. This is joint work with your former president, Professor Young-Chul Park, and I'm also very grateful for him to, number one, inviting me to co-author this work with him and for his very valuable contributions. I will give the overall presentation, but of course, I very much hope that he also can step in during the Q&A part of this session. What I would like to do is I would like to focus on 4 points during my short presentation. The theme, of course, has been set already by the introductory remarks. How do we recover from COVID-19 and from the socio-economic repercussions of the pandemic? And what role can the financial sector play? Number 2, I would like to take a bit of a longer term perspective, longer term in this case, 30, 40 years, in terms of the structure of the financial systems and specifically banks' balance sheet. Then in a little bit of a longer part, I want to specifically discuss the role of digitalization, how this affects the incumbent financial institutions, what kind of scenarios can be envisioned going forward, as well as the role of crypto assets. And then finally, one important challenge, not long-term anymore, I would say more short to medium term, is of course the necessary transition to a net zero economy, and what role can the financial system play here. Now, in each of these topics, of course, I can only give a very short, make short interventions. I'm not going to make exhaustive arguments, but focus on some simple points. So let me start with discussing the role of the financial sector through the pandemic and beyond. Well, the first observation, it's just to remind ourselves that this crisis, unlike the previous big one, the global financial crisis, did not start in the financial sector, but rather it has not been caused by macroeconomic or financial sector imbalances, but has been due to a exogenous public health shock, which then had repercussions directly through aggregate demand, supply side disruptions, and of course through lockdown measures. The financial sector initially has been affected as negatively as many, if not most, other sectors across the globe. However, at the same time, the financial sector also had a very critical role in the transmission of support programs for the real economy by the government. And we could see this again across the globe, from very basic-ish things, just the support payments being paid out by the government for household and enterprises through the payment systems, through the banking system, pushing out loans, pushing out loan guarantees. In the US, for example, you had a paycheck protection program, which went through the banking system, and where, as research has shown, especially the smaller banks, the local banks, played a very important role. So the financial sector did have a critical role in helping address the socioeconomic fallout of the pandemic. Now, it doesn't end here, I would argue, but it is also important that the financial sector also has an important role when we exit this crisis. And here I'd like to kind of look at it as the contrast between Keynes versus Schumpeter, or Keynes versus Hayek. On the one hand, we would like to maintain, for primarily macroeconomic, but also social reasons, support as long as necessary to avoid hysteresis, to avoid unnecessary unemployment and social losses. On the other hand, we know that there will have to be resource reallocation, and we know that the financial sector has to have an important role in this resource reallocation. So how quick to withdraw the support, hopefully not too prematurely, but also not too late, in the sense that this ultimately will just limit the resource allocation, might lead to zombie lending, as we've seen it in other circumstances, and ultimately depress medium to long-term growth rates. And again, the way support measures for the real economy, but also certain regulatory measures, think about capital relief, think about changes to loan loss classification, but also stress testing, for example, depending on how quickly these measures will be taken, or these measures will be withdrawn, will determine the role of the financial sector in terms of helping the recovery quickly, swiftly, or actually holding it back, or in the worst case, leading to further problems down the road. And just to illustrate this with 3 points, so this is some discussion that we are currently having here in Europe, for example. When you remove fiscal support for corporations and households, this will have implications for banks who so far have been indirectly supported, because households and enterprises can continue making their loan repayments because of support payments, but might not be able to do it anymore if the support payments stop. If you force banks to recognize losses, which they haven't been fully forced to, if capital relief is being reversed, so capital buffers have to be rebuilt, this of course can have implications for corporate, especially for corporate borrowers, if it results in a lending retrenchment. Finally, the question is, if you force banks to acknowledge, to recognize non-performing assets, how will these non-performing assets be dealt with? Inside banks, or through bad bank structures such as asset management corporations? So what I'm trying to illustrate here is that these different policy decisions by central bank, governments, regulators kind of are interconnected and have to be coordinated in order to allow for a smooth exit from the crisis and from the support during the crisis, and avoid any cliff effects on the one hand, or depress growth in the medium to long term. So this was about the pandemic. What I now would like to talk about a bit more is about a long-term perspective in terms of the role of the financial sector for the real economy. I'm showing you here 2 pictures. These are both pictures that show correlations, but behind these pictures is a long literature that has kind of identified a certain causality between the development of financial systems and economic growth. On the one hand, there is this positive relationship that holds even when we control for reverse causation, for middle variable bias. On the other hand, and that's on the right-hand side, there is also a certain non-linearity that financial systems have limited impact on economic growth at very high levels or in high-income countries, or might even have a negative impact if the financial system grows too big. Now, we know from a long literature that finance can be important, basically for the running of a modern market economy, so more on the individual level, but also on the aggregate level through increasing informality, formality, efficiency, improving resource allocation, but also enhancing competition and innovation by allowing for entry and exit of firms. However, as I just mentioned, we also know that there can be too much finance, or more specifically, there can be too much credit. We've seen it, for example, housing booms and busts, US, Spain, Ireland, and of course also asymmetric incentives, kind of summarized in this wording of one side, I win, other side, you lose. One can also explain this maybe too much finance with an overexpansion of bankings beyond the pure intermediation business into other more speculative areas such as trading on their own books. And finally, there could be a negative spillover effect from a financial sector that is too big by causing a brain drain from the real into the financial sector. So when your physicists and your IT experts and your mathematicians suddenly all start working for bank, start working, instead of working in labs in the real economy and helping real innovation, that can ultimately depress productivity in the economy. And again, there is some empirical evidence for that. Now, beyond that, there might be another reasons why we don't see any growth effects of financial development on very high levels of credit to GDP or in high income countries. And that might be the increasing role of consumer, of household, of mortgage credit in banks' balance sheets, which has increased dramatically over the last 60 years. This is by a recent paper by Carsten Müller and Emil Werner. As you can see that there's almost as much household credit as there's firm credit by now in this large cross-section of countries. And there are countries in Europe, for example, where 80–90% of loans on banks' balance sheets are in the form of mortgages and not in the form of enterprise credit. Countries such as Netherlands or Denmark, for example. Now, what implications does it have? Well, we know that household credit doesn't have the same kind of role in economic growth than enterprise credit. We also know from recent work, as for example, from this paper by Müller and Werner, that actually credits going to households and credits also going to non-tradable sectors, such as construction, for example, can result in more destructive boom and bust cycles, more stability damaging and ultimately growth damaging boom and bust cycles than credit booms to tradable sectors, for example. This is one kind of also long-term trend on banks' balance sheet with implications for economic growth, but also for financial stability. Now, a second trend I want to briefly point to is on the change of assets on corporates' balance sheet, a shift away from tangible machinery, property, to intangible assets, R&D, goodwill, patents, and so on. Both in terms of within sectors, but also an increasingly important role of sectors that rely more on tangible assets in modern market economies. And now, in some recent work that I've done with a couple of courses, we've shown that number one, and that's actually a more broader result also from other work, banks are less likely to finance intangible assets than they are to finance tangible assets. And number two, financial sector development, banking sector development is associated with higher investment in tangible assets, but it's not associated with higher investment in intangible assets. And ultimately in this work, we also show that the increasing role of sectors relying on intangible assets in high income countries can explain why we don't observe this relationship between finance and growth any longer, why it basically turns insignificant. Again, because there is no important role, or there's a less important role for banks in terms of funding intangible assets as opposed to tangible assets. Now, of course, you can bring these 2 points that I just made on the increasing focus of banks on mortgage credit on the one hand, and the increasing focus of corporates on intangible assets together and say, well, maybe that is exactly why we observe the shift of banks towards real estate lending, both retail real estate, but also commercial real estate, and much less on the financing of corporate assets, for which there is now a much higher demand. This also goes hand in hand with the observations that firms relying more on intangible assets also use much less debt and have much higher cash buffers, again, partly for the reason that the profitability of these firms is very low at the beginning, so they need a certain buffer of cash in order to survive for several years before their investment in intangibles ultimately pays off. The question, of course, going forward is, well, what will, if these trends continue, how will banks' balance sheet look in another 10 or 20 years? Will it all be about just consumer household credit? Or will they end up only with shrinking industries? Right, rather than with the innovative growth industries? I mean, that's a question that we can't really answer right now, but it's certainly a question that we should ask. Now, a third point I want to very briefly make, it's maybe not it's a trend that we've observed for many decades. This is the increasing role of non-bank financial intermediation, what used to be called shadow banking, which on the one hand, you can argue, well, maybe it's good because you have diversity of financial providers, which is good for borrowers in a financial system. But of course, this poses new regulatory challenges in the sense that many of these non-bank financial intermediaries, many of these shadow banks arise ultimately to avoid more stringent regulation inside the regulatory perimeter. So the risks basically escape the regulatory perimeter are being shifted outside, and the regulators are playing kind of a catch-up game where the cat follows the mice as much as possible, but never can catch them. So this is just one picture here, Europe, which actually is somewhat behind in terms of the role of shadow banks, but even here, the role has increased over the last couple of years. So the final point, and that brings me to a kind of a broader discussion, is the role of digitalization, or also the rise of fintech and big tech company that we have been observing over the last 10 years. And that might also increase now even more after the COVID crisis. Again, these being firms, especially the big tech companies, that are intangible asset companies, platform companies, and they certainly will come out of the crisis with a very healthy cash buffer compared to the banking system. So financial innovation has been a feature of the financial sector for centuries, but one can argue that the recent technical innovation that we've been observing has really kind of led to significant changes. First, there's the mobile technology, there's internet, APIs that have enabled a quicker information exchange, new delivery channels, but also an easier exploitation of economies of scale. We've seen the rise of internet banking, but also of mobile money providers, especially in the many developing markets where people are more likely to have a mobile phone than to have a bank account. The IT revolution has facilitated the creation, the processing, and ultimately the use of big data for financial risk management, measurement, and management, making it easier to predict default probability of borrowers. Also, for example, the likelihood of insurance incidents, but also robo-advising for investors. Now, of course, and I'm going to come back to this later, there might also be risks involved here, such as, for example, that certain parts of the population that pose too high risk and whose risk can now be observed even more carefully are completely excluded from the financial system. You have the so-called distributed ledger technology, crypto, Bitcoin, blockchain, smart contracts. I will come back to this in just a moment. And of course, all of these technological advances have also helped on the trading side. So one way is to look at it on these different innovations from the new techniques, the new products, the new services. Another way to look at it is to say that these innovations have given rise to new types of competitors. And here we typically like to distinguish between fintech and big tech, where fintech companies are typically smaller players, many of which are active in the payment sector, payment system, payment services, offering very specific solutions, some of them also in the credit side. For example, in the US now, a lot of mortgage loan originations is done through fintech banks with bank licenses. And this has actually given, they have by now taken quite a big market share. That's on the one hand, but the bigger competition for banks might actually not come from the fintech companies, which are kind of new entrants, but rather from the so-called platform companies. So these are the Amazon, Apple, Facebook, Google, or in China, for example, the WeChat or WeBank, Alipay, or also in other parts of the world, for example, Mercado Libre in Latin America. Now, these are companies which have a big footprint in other parts of the service economy and basically can use their data availability from these other segments, their enormous network advantage, and these strategy to go from non-financial into financial services, offering, for example, payment services underpinning their intermediation services, expanding credit, as for example, PayPal is doing it in the US, offering money funds, as for example, is done already in China, or serving as a platform for insurance, looking for insurance contract, as we've also observed it already. So these, again, these big tech companies have the advantage, lots of data, they have network externalities, and this together can basically allow them the kind of an virtuous circle to get even more benefits for the future. Now the question is, how will banks react to this possible entry of fintech and especially of big tech? Now, for the moment, one can argue that banks do have a privilege or have an advantage by the privilege of private money creation, which you basically only have if you do have a banking license and therefore access to the central bank. We can observe that banks do face competition in specific business lines. And ultimately, if there's an unbundling of these different financial services that banks currently offer together, payment, credit, risk management, savings, then ultimately the scope economies might get lost for banks. Now, again, it seems to be that it's mostly the big tech that are being seen as a bigger challenge for banks rather than the fintechs, which often, if they have a good solution that is also attractive for banks, they're actually being bought up by banks. Now, with these new innovations, and especially also with the new providers, come new risks. One, we have kind of what I like to call old risk with a new skin. If you have bank-like intermediation models, let's say these lending platforms, then this can ultimately lead to risks. And we've seen it before that if you have non-regulated entities in a crisis situation, ultimately the safety net might have to be extended to them. We've seen this with the money market funds, for example, in 2008. Big tech platforms, again, by their construction, by their functioning, are big. They often have a market dominating position, which of course can make them too big to fail. A stronger focus on purely transaction-based intermediation based on big data might also make it more pro-cyclical. And ultimately, if the banks face more competition from these non-bank providers, they might react by more risk-taking. This is the so-called competition fragility or franchise value fragility hypothesis that has been put forward and for which there is quite a lot of evidence. Now, additionally to these financial risks, there are also a number of non-financial risks, and I don't have the time to go through all of them, but maybe to kind of summarize it, there's an increasing focus on, again, market-dominating non-financial IT providers, and there might be a too high of a confidence in technological solutions, which if they fail, might actually lead to widespread disruptions. So one specific part of this alternative finance I want to very briefly talk about is crypto. This goes back to the blockchain. This, I mentioned this earlier, the distributed ledger technology, and Bitcoin, which is based on the blockchain as kind of a private currency, decentralized currency, also coming with a decentralized payment system. Now, these have taken off quite a lot. Of course, they haven't really functioned as an alternative to fiat money, given their highly volatile value if you compare them, well, both to each other, but also to fiat currencies. And of course, some of these cryptocurrencies have also been used not exactly for the more legal purposes that we use fiat money for. Now, this high volatility has then led to other types of cryptocurrencies, such as the stable coins, for example, which are pegged to fiat currencies. Sometimes they even function in kind of with a currency board mechanism, so they're kind of underpinned with actually fiat money or money-like assets. Now, the issue here is, and this is an industry that has really grown quite a lot, but I would argue it is mostly speculative, and so far I don't really see any clear kind of alternative to the incumbent financial system, or even a threat to our current monetary system. What would make it more, and you've also seen, of course, that it's a very inefficient means of transactions, including, of course, also it is a very environmentally damaging form of transactions, given that the mining of Bitcoins, for example, comes at a very high energy cost. So one can really ask the questions whether this crypto financing adds any positive value from the social viewpoint. And I would probably argue that no. Maybe it will turn out to be, in the best of worlds, it probably will turn out to be the 21st century equivalent of the tulip mania, or it could be even worse. The issue is, will ultimately this industry, the crypto industry, integrate with the incumbent financial system, or will it stay apart? The biggest concern is less the purely private cryptocurrencies, but more the stable currencies, for example, Libra, or now called Diem by Facebook, which kind of can pose a competition to fiat money, which therefore has then been addressed by some central banks kind of considering the issue of central bank retail cryptocurrency or retail digital currencies, which of course ultimately might undermine the current model of banking that we have, where banks are the ones with the privilege of private credit money creation, which, if such digital currencies take an increasingly important role or even crowd out bank deposits as quasi-money, that of course would have implications for the structure of the banking system and for the role of the banks within the financial system and for the real economy. So the last part of my presentation, when I want to briefly talk about, and again, I'm going to be very selective here, the challenge whether the financial sector can contribute to a green transformation, to a transition to net zero of the economy, which of course, as we know, has become more and more urgent. We're not talking about a generation anymore, we're talking about a decade or even less when this has to happen. Now, if you again look at the broader picture, if we look back at the finance and growth literature that I kind of referred to earlier, the financial sector is seen as critical in allocating resources and production factors. So why should it be different in the context of a transition to net zero? Because we do need productive factors to be reallocated away from the fossil fuel, from carbon intensive industries and sectors, and towards clean industry, green industries, but also green innovation. One question, and that's what I'm going to focus on now, is which segment of the financial system is best suited to support this transition? Before, let me just say there is some evidence of a so-called environmental Kuznets curve, which basically shows that as countries develop, and of course, especially in the process they industrialize, CO2 emissions go up per capita before they eventually turn down for different reasons, the rise of the service industry, but also, of course, more environmental conscious. Now, the question is, how do different segments of the financial system help with this transition? And here, one paper I'd like to briefly discuss by actually both co-authors of mine, Ralf de Haas and Alex Popov, who basically look at the reallocation both across industries and within industries from kind of brown to green technologies industries. And what they basically find is that market-based finance, or as proxied by stock markets, is more associated with higher growth in clean sectors, whereas credit market deepening or banking sector development is actually associated with lower growth in clean sectors. So it seems to more kind of the market-based finance that can help with a transition to net zero than a focus on the banking sector. And again, this holds across different settings, across industries, within efficiency improvement within industries, but also, for example, new entrants and new patented innovations. For example, more green innovation in the so-called dirty sectors. Now, a second paper that kind of comes to a similar conclusion, but actually looks purely at debt, comparing credit with bonds, finds very similar results, where the bonds of fossil fuel firms do actually come at a premium compared to non-fossil fuel counterparts, while these authors cannot see any such difference for syndicated bank loans. So there's no kind of a discount for bank loans, but there is actually for bonds. So again, market participants seem to react more prominently to the needs to shift to non-fossil fuel industries than banks do. Now, why is it that banks are so reluctant to support a green transition? Well, that's the third paper I want to briefly quote. Well, it could be that the entry of innovative, of green firms in polluting industries actually risks devaluing the legacy position that banks hold with their incumbent clients in these same industries. And I mean, this is not just doesn't just refer to green innovation, but it relates in general to new entrants and to innovative companies where banks basically fear that the rents of their existing clients is being undermined. And typically, the more homogeneous and concentrated banking system is in a given industries, the fewer new innovative firms will ultimately be granted these loanable funds. So again, it seems to be the case that if we want to focus on a role of the financial system in kind of fueling transition to net zero, to green innovations, we need a look beyond the banking sector to other segments of the financial system, be it market finance or be it, for example, venture capital to help with this transition. Very briefly, I'm already out of time. One final remark, how can we regulate, what can we use regulation to kind of push, for example, the banking sector towards greener investment? For example, to the form of penalizing brown, supporting green factors. There's a very interesting paper by Martin Oemke and co-author that basically shows that if it's for purely prudential purposes, again, relating to stranded assets, for example, and higher risk that comes from dirty industries going forward, then yes, but these kind of green capital requirements are much less effective in addressing externalities. And it is here where we really would need taxation or carbon pricing. Of course, you can also see this in the broader context of the so-called Tinbergen rule, that if per instrument, you should have one policy objective and not several. So let me summarize, let me conclude. So on the one hand, I talked briefly about the future of finance in the terms of what is the impact of digitalization on the structure of the financial system, which will be very much endogenous to the regulatory reaction. How will regulator address the entry of big tech? We've seen it, for example, in China, that ultimately there has been a backlash against the big techs taking on a more and more prominent role in the financial system. And very important will be the structure and the design of these central bank cryptocurrencies. The future of finance, will the trend towards consumer finance continue? What implication does it have for the role of, especially of banks in this case, in the real economy? And then turning it around, finance for the future, there is certainly a critical role in the transition to net zero, but not all segments will have the same role. Thank you very much.
Thank you very much, Professor. I would like to ask Professor Park also to please come up to the stage, as well as the discussant. Just a brief housekeeping announcement. For those of you who are online and offline, we have a chat room. If you have any questions, please submit your questions and write your questions in the chat room. We'd like to ask our senior researcher, Lee Sang-jae from KIF, to moderate the Q&A session. Please go ahead.
Thank you, Professor Back, for giving us a very impressive lecture that covered a wide range of topics on future of finance. It was very neat in such a short time. If I may summarize Professor's presentation rather roughly, first he shared with us thoughts about the role of the financial industry to support the recovery process of the real economy post-COVID. And then he moved on to the subject of changing environment, changing financial environment, and the long-term trends in the competition structure of the financial industry and resulting new risks. And after that, he briefly discussed challenges and opportunities that the crypto obtained with the crypto industry. And finally, he talked about how the financial sector can contribute to green transition of the economy. And to talk about these issues, we invited two discussants. One, the co-author of this, although we don't have the full paper now, we now have only PPT slide. The full paper, co-author of the full paper, Professor Young-Chul Park. He is now currently an honorary professor in economics at Korea University. And now we have another panel discussion from Kim Yoon-ju, Managing Director and Partner in the Boston Consulting Group. For this session, 1 hour is allocated to this first session. We already consumed about 40 minutes, and so we are left with a very short time. So I think each discussion will have about 10 minutes each. So let me first start with Yoon-ju Kim.
Thank you, Mr. Lee. And also thank you very much for Professor Beck for a very insightful perspective from as a global expert. I think you put everything important on the table, including the crypto, which is a very big issue in Korea, also the net zero, which is a very big issue globally, but a little bit late and a belated response in Korea. So thank you for bringing it on the table. So bridging his discussion, I would like to a little bit more focus on Korean market. Also, as a management consultant, I would rather focus on FI industry rather than a macro perspective of government policy. So that's my plan. Before going into the slide, can you please change the? Can you please open my slide? Okay, before explain about a couple of pages, I would like to give you my brief view on the Korean financial institutions' response to COVID-19. Professor Beck also talked about the short-term response and long-term response. For the short-term, I think that Korean financial institutions and the system has been pretty strong and very well response to the COVID-19 situation. So now we are with Corona. We haven't seen any big and dramatic risk from COVID-19, which is because the government and also financial institutions are well prepared and has a very good balance sheet, and so they successfully react to those crises. So now it's more time to focus on long-term sustainability. So there are many changes here in the market, so it's good timing to think about mid to long-term sustainability of financial institutions. So when you talk about the big challenges which financial institutions are facing, it's about Korean situation, but many of them are very similar to what Professor Beck already mentioned, because it's all important trend and symptoms are global. So global trend are exactly apply to Korean market in many cases. So I would like to emphasize a couple of things. So when you talk about the macro challenges, there are big issue in polarization in the society. So rich people getting richer and the poor people getting poorer. That's a global issue. And the COVID-19, that's a more serious issue now. And also in digital, already Professor Beck mentioned the competitive dynamics are rapidly changing, and then we need to compete against not only the fintech, but also big tech, Also, financial institutions need to apply the deep tech such as AI, blockchain, distributed ledger technology. So it's make the company more difficult to compete against those new entrant. Also, the DeFi and crypto is another big things that we have to, or financial institutions and government need to react. So I fully agree on what Professor Beck mentioned, that regulatory guideline is necessary for this area. Without that, now like emerging and the growing crypto market cannot be controlled. And lastly, the human behavior is a big issue. So we are facing new customers, and then we are working with new employees. So social demand also very rapidly changing. So reaction to that is very important. So in this uncertain environment, which is globally facing, also all financial institutions are facing, I think that I would like to propose a new framework. So 1X is how to react in the business and operating model, meaning that to survive in this environment, how financial institutions are changing themselves into their business model and operating model. But at the same time, what really important is how financial institutions are getting enough trust from the society and then customers. Because all changes we are facing right now is not just the business strategy, it's about more social and fundamental macro perspective. So even though financial institutions can change in strategically, they also need big trust because we are facing uncertainty. So I would like to read a further explanation on one by one. So for the business operating model, as I mentioned, all the challenges. So financial institutions think about many new things right now. For example, the core focus, not just the original like financial system. They have to think about digital asset, also DeFi, not just the fiat currencies. Also in terms of a client, many financial institutions think about just the big segment approach. Big corporations, small corporation, rich people and poor people, but that's not true. Now they have to facing many different persona in society. In terms of competition, I already mentioned, compete against the big tech and platform company. In terms of channel, digital and offline all together. In terms of product, not just the simple financial product, you have to think about more than that. Connecting to the real life and then more dynamic product type. In terms of technology, also they need deep tech. And organization also need to move fast in agile. So these all changes are very difficult, but they have to do. And I believe all the Korean financial institutions react this in certain manner. But the more difficult thing is, I think, how to get trust between these whole changes. Because when you think about our society, when you talk about our customers, they have to move forward with financial institutions. But if they don't have the trust, they cannot do it together. So all crypto issue, all net zero issue, already Professor Beck mentioned, we have to go forward for the uncertain world. All Korean customers and corporate need to move forward with financial institutions who understand well and who are trustworthy. So if financial institutions can do well, meaning that they can adapt and change themselves well and get the trusted together at the same time, they can be an orchestrator, meaning that help customer in a very dynamic way and then make customers and client and society successful. But if they fail to get trust, then maybe big tech and platform company get more trust than financial institutions. Then financial institutions are gonna be just a utility, just giving the product based on regulation, but they cannot get the full trust from them. And if they get trust, but they fail to adapt themselves to the new society, new trend, they have a niche, a very small financial institutions because they cannot cover everything. But if they fail to get neither of them, I think they will leave from the market. They cannot survive. So just in summary about my discussion. So as Professor Beck mentioned, markets are changing very rapidly globally. And then most of the global trends are now in the Korean market. And then Korean financial institutions did really well for the short-term recovery response. But in the mid to long term, there are many things to prepare and lead in the market. So it's timing to change themselves in a business model, but at the same time, increase the trust level from the society, which is very, very difficult task they have to overcome. So I think they need very fundamentally different approach. First one, they have to think about the innovation at a broader level, not just innovate how they do the business. They have to think about full digitalization. They have to think about how to work together or embedding crypto world and DeFi world. At the same time, they have to support large society system which bring the net zero world. So that's what banks and financial institutions are move forward. In order to do that, they have to aggressively get the capability, new capability. Within the current financial institutions, they cannot do this. So they have to do M&A, they have to make a new investment, they have to hire new type of talent into the financial institutions to do this. And also they cannot do, even though they get a lot of capability into the financial institutions, they cannot do by themselves. They have to work together with the society and the other ecosystem. So they have to partner with other companies, other institutions, even they have to work very closely together with the government and authority. Thank you.
Thank you, Yeonju Kim. Future of finance is always uncertain, and he elaborated the Professor Park's presentation more in terms of macro challenges and digital disruption and human behavior. And he also gave us talk about the key choices for Korean financial institutions to manage the change and innovation journey. Professor Park, do you have anything to add to this topic? Or?
No, I'm just going to respond to your comments on the maintaining trust from the client. And my question is, in your view, whether financial consumers, households, as well as corporations begin to trust many of these big techs they have to deal with, like Naver, Kakao, K-Bank, KT. I mean, all these big techs, there are quite a few in Korea. And do you think people do trust the financial activities of these big techs more than they trust banking institutions? What is your assessment?
So I think the trust points are very different. So customers trust about financial institutions for their financial stability, and then their expertise in finance, and their big balance sheet. And then the fact that they can go to branch and then meet the people. But the trust point for the technology company is very different. They trust about experience. They did it, they know it, they enjoyed the trust experience. So it's very different. So when the big tech and fintech start to the financial, coming into financial sector, especially the young people who like the experience, love that. So they actually buy in some trust. So trust factor is very different, and also little younger people toward more customer experience, and the senior people, rich people more toward financial stability and the product expertise. So it's mixed up. So how to overcome? For the perspective of financial institutions, they also need to provide a better experience. They can buy in. So young people will use financial service from financial institutions if experience is good enough, and fast enough, and fun enough. And for the perspective of fintech, if they can get bigger book or better partnership and better stability, and the long-term stable like sourcing of the product in a good way, then they can build up trust as well. So they are moving the other way to get trust from the older customer level. So I don't know who will win at the end. The player who move faster, I think they can win and they get a bigger trust.
Don't you think we should think about regulating financial operations and activities of some of these large fintech and big tech firms? Related to these questions, why do you think so many young people are attracted to the internet banks switching from traditional banking services to internet banking services? So the two questions is, do we need some sort of regulations for the big tech's operations, financial operations? And then what about this internet banks? Do we need more of these things? And why there are so many people are coming to these new banks, internet banks, which have now established their trustworthiness. And in fact, we don't know what their future will be, but nevertheless, people are very much interested in and then start using these services simply because of the convenience or what? But convenience can be provided to banking institutions as well.
So I think the reason why young people use the internet bank and fintech, as I already mentioned, is because of the experience and then connectivity to their other digital services. But the regulation point is really different for internet bank and fintech. Because internet bank is legitimate bank. They got the full license, they have the required capital, they got all the regulation required as the bank. So there's no other way to believe that they are a tech company. They're tech, starting from tech, they get the license already. So it's there on the common regulation background. But the fintech is really different. When you talk about the fintech, they have a small license, or just a simple license can sell the product, but young customers believe that they are full financial institutions. Then some issues come up. So what regulation has to do is to think about how to regulate the other fintech, just for more on customer protection or customer perspective. If customers think differently, meaning that even though they are fintech without enough regulation or enough book stability, but they think it's the same as an internet bank and fintech. So we have to apply same regulation for the same activity. So if fintech start to do more and more financial activity, then just bring them into the financial regulatory boundary and they give them the same regulation, then it would be fair. But vice versa, if big financial institutions start to do some innovation and new venture, then we have to allow them to do with lighter regulatory framework. Then it would be fair, and then make all the customers know the differences. I think that's important.
And I checked YouTube real-time presentation, but we don't see any questions on the real-time chatting window. So we are still left with some time. So Professor Bldg is still with us. Do you have anything to add on this discussion?
Yes, thank you for this. Actually, I find it very fascinating discussion, and also thank you very much to Mr. Park to Mr. Kim for bringing in the additional perspective, kind of, I guess, bottom up, right, from the banks themselves. And I think a lot of what he said kind of also matches just on a more aggregated level what I've been referring to. So I think when we look across countries, what we often see is that where banks don't provide the necessary services, they're not accessible, that's where new providers, if they are allowed, can easily come in. I mean, we've seen it, for example, with mobile money providers in several African countries, again, based on the observation, based on the fact that more people have mobile phones than have bank accounts. And the trust, if your primary financial service needs are for payment transactions, and you can verify that the transaction has arrived on the other side within a couple of seconds, that of course creates immediate trust. Trust that in some countries banks simply don't have, because based on past experience, on past crisis, for example, right? Or for example, in the UK, lending platforms became very popular after the global financial crisis, because, I mean, UK banks don't exactly have a reputation in SME lending in the first place, but they also kind of withdrew from the SME lending market after the crisis, or actually started mistreating actually some of their existing SME clients. So again, this is where basically banks don't offer good services or don't offer any services. That's where you typically see these alternative providers coming in. Now, I also agree, and that's more on the second point on the stability side, that of course, ideally we would like to go for activity-based regulation and supervision, but I think that's easier said than done. Because, I mean, take the lending platforms, for example. I mean, there are different models where lending platforms sometimes don't have any role, no money, but sometimes they do have a certain own capital in there. But what if investors, even though they're being told that their money is at risk, what if you have many of these investors suddenly losing their shirt? So you can get easily to a situation, although such a financial institution or financial provider is not part of the regulatory perimeter, because again, they're not strictly speaking offering intermediation services, but then for economic reasons, suddenly the regulatory perimeter, the financial safety net, has to be expanded to these providers. So I think that's always a concern. And again, we've seen it in previous occasion. I mean, for example, in the money market funds in the US in 2008, when we basically broke the buck. So alternatively, what if big techs don't offer directly financial services, but serve, for example, as an intermediary for banks? So kind of try to use their data advantage on their platforms to basically match borrowers with lenders. Now, again, the incentives might then turn into kind of volume-based incentive, where from the big tech viewpoint, the more, the better. A little bit like the incentives that many loan officers faced in the subprime mortgage segment in the run-up to the global financial crisis. Of course, that can create additional risks, additional fragilities, again, if there are kind of perverse incentives to push out lending while these platforms ultimately don't underwrite the risk, which then would still stay with the banks. So what I'm trying to say is that activity-based regulation alone might not help us to address all of the potential risks that might arise from an increasingly important role of these non-bank providers in the financial system. Thanks.
Thank you, Professor Back. Regarding this big tech and big bank discussion, we recently, the KIF recently published the conference results. I think last year we had a conference regarding those big tech and fintech, big tech and big banks. And if you have any further, you're interested in, you can refer to those working papers published by KIF. And I think the time is about 9:10, and this is we almost consumed the time we allocated to this session. Any questions in the floor? Thank you. Then I would like to wrap up this first session. Thank you, Professor Bag, and thank you, Kim and Professor Park. Thank you.
Thank you.
예, 감사합니다. 정확히 시간에 지켜주셔서 감사드립니다.
Thank you.
그 다음 세션에 앞서서 10분 동안 잠시
Before we move on to the next session, just allow us 10 minutes. We will begin at 20 past 10.
잠시 후에 시작하도록 하겠습니다. 혹시 밖에 계신 분들은 안으로 들어와 주시면 감사드리겠습니다. 네, 그럼 지금부터 오늘의 그 컨퍼런스 두 번째 세션을
We will now
시작하도록
begin
하겠습니다.
session 2 of the conference.
그러면은 먼저 발표부터 듣겠는데요.
We will listen to the presentation from Professor Daron Acemoglu of MIT. Please go ahead.
Thank you. Thank you very much for the invitation. It's my pleasure to be joining you, albeit remotely. So now I'm going to share my screen and hopefully that won't be a problem. Okay. All right. Can you see my presentation? Wonderful. So I'm going to talk about confronting the challenges of the post-COVID world. I think there is broad agreement that there are many major problems we are going through right now, but I will put my emphasis on 4 issues that I think have worried many countries rightly. Huge increases in inequality, aging, climate change, and collapse of democracies. Associated with that also the decline in trust in public institutions. I will also talk a little bit about how developments in the global order, especially cooperation within the context of global institutions, is worsening and complicating any type of solution to these problems. The emphasis I want to have is about whether we have the right institutional framework for dealing with these challenges. I think 2 sets of ideas have been particularly influential in a synergistic way in the way that we think about these global challenges. The first one is the perspective articulated by Milton Friedman in 1970, but also several other economists and public thinkers before, which sometimes goes under the label of shareholder values, that firms are best when they look after the profits and the benefits of their shareholders. And this is especially important when we are trying to garner new innovations or adaptations. And then institutions within this view, and that's the synergistic part, should provide a stable rule-based environment in which firms can function efficiently, and then these institutional and firm sort of nexus will generate a lot of innovations. The government's role is to bolster these innovations and then do as little regulation as possible, although, of course, everybody recognizes that some amount of regulation is necessary. So is this the right perspective for the 21st century, especially in light of the challenges that we're facing? I don't think so. In fact, I think these 4 challenges will highlight that our existing arrangements are not up to the task of dealing with these challenges. In fact, I would go so far as to say that we are in the midst of what Jim Robinson and I called in Why Nations Fail, a critical juncture, a period in which existing institutions are generally understood not to be a good adaptation, a good sort of solution to problems. And there is a lot of fluidity, and then there's room for agency and political choices in deciding how new institutions are going to be forged. So periods of critical juncture are problematic periods because sometimes very worse developments can happen, but also they are hopeful periods in which we can forge better institutions. And I would say that both elements of the existing sort of global institutional paradigm need to change. I think we have to provide incentives for firms to behave differently, and the institutions have to shoulder new responsibilities in a way that I'm going to articulate. Indeed, it is already sort of telling that even the business world is aware of this. The Business Roundtable of big companies and their CEOs has recently come out and said that we need to move away from shareholder values and corporations need to serve all of their stakeholders. And when you look at the US, I don't know exactly in South Korea what the equivalent of this is, but in the US, if you're listening to podcasts or the radio, you can hardly go a day without listening to Facebook advertising its commitment to new internet regulations for the public good. Philip Morris and Altera talking about their plans to make smoking history, ExxonMobil, BP announcing 5-year climate plans to reduce greenhouse gases. So perhaps you might actually think that out of the existing institutions, something better is coming out by an organic process. Actually, I don't think so, and I think current proposals are insufficient, and in fact, they might actually go in the opposite direction by empowering CEOs, which would be the wrong way to go. And I think confronting these new challenges, as I'm going to try to articulate, requires much greater institutional reforms, where democratic process is going to be very important, and I'll come back to that. And in particular, what I'm going to emphasize, although this is not the only aspect, but this is the one that's the closest to my heart and most related to my research, regulation of technology has to be central to it. So we need a new framework for regulation of technology in a way I'm going to try to articulate. So in the rest of this talk, I will talk about these 4 areas of challenges plus the collapse of the global order and try to articulate this view of why we need new institutions and why regulation of technology has to be central and why this will have to involve different priorities on the side of firms, especially multinational firms. Let's start with inequality. And in all of these cases, I will start with the US and then provide global evidence as I go along. So in the US, I think something quite telling can be seen from these 2 charts, which show the evolution of labor demand. Overall wage bill, employment times average wage of the private sector. And on the left, you see a very remarkable increase of the wage bill from right after World War II's end to the mid-1980s. It's a remarkable growth in that in real terms, wage bill grows by more than 2.5 percentage points in real terms than population. So if population to employment ratio remained constant, this would imply that average wages would grow by more than 2% a year, every year in real terms. But on the right, you see a slowdown of wage bill and then a complete flattening, so much so that from the late 1990s to today, the private sector is hardly paying more to labor than it did. This has been associated with, I would say causally, with huge changes in the US labor market. One implication, of course, is the decline in the labor share. I'll come back to that. But another one is actually the huge increase in inequality in the US. So these 2 charts summarize the inequality in the US with some detail. They show the evolution of real wages for 10 demographic groups. The dark red is high school dropouts, all the way to dark blue workers with postgraduate degrees, and separately for men and women. What you see is that in the 1960s, and the same was true in the 1950s, you had a period of fairly shared prosperity, meaning that real wages for all these 10 demographic groups were growing more or less at the same rate. But from around 1980, you have a very different pattern. The top and the bottom open up. That's the huge increase in inequality. But even more troublingly, wages at the bottom, especially for low and middle education men, is declining in real terms, fairly sharp declines. In fact, even for college graduate men without a postgraduate degree, the light blue, there's little wage gain since the late 1970s. This increase in inequality has been associated with huge social costs and, of course, some political implications, as I'm going to come back to in the context of democracy in a second. Inequality is not just a US phenomenon. US has the dubious distinction of being the inequality leader within the OECD, according, say, to the Gini coefficient or any other coefficient that you want. And it has had one of the largest increases in inequality, but inequality increased pretty much in all of the OECD. In some cases, very sharply, Germany, Sweden, the UK. And in some cases, including Germany, UK, New Zealand, and Australia, there were declines at the bottom as well, although many places, the labor market institutions protected lowest paid workers, so that the picture in the US is quite distinctive in that respect. More striking, perhaps, than the common trends in inequality is the common trends in how the employment distribution has changed. Shared prosperity was in part bolstered by middle-class jobs in the United States, and likewise in many of the other industrialized nations. Those middle-class jobs are those that are not at the very top, like managers, lawyers, surgeons, and are not at the bottom, like cleaners, household help, or food preparation workers. They include operators, manufacturing work, blue-collar workers, white-collar back office workers, clerical workers, and so on. But what we see in all of these countries is that the middle third occupations have declined relatively. So the red bars are all pointing south, meaning that we are seeing these middle-class jobs, especially for non-college workers, disappearing everywhere. In some places, they are replaced by lower quality jobs, the blue bars. In some places, with somewhat higher quality jobs like technicians and et cetera, especially because education is also increasing during this time period. But the disappearance of these middle-class jobs is very common. And these are also the jobs that are at the crosshairs of automation. The white-collar office clerical jobs have been those that have been automated by office software, and blue-collar operator jobs have been those automated by dedicated machinery, numerically controlled machinery, and more recently by robots. In fact, a lot of my research that I think is relevant for our discussion here centers on thinking that we cannot really make sense of the recent period or the longue durée of the 20th century by just thinking of technology as something that increases productivity. We have to distinguish between different types of technologies, and in particular, we have to sharply distinguish technologies that automate and displace workers from the tasks that they used to perform, and technologies that reinstate labor, for example, by creating new labor-intensive processes, new tasks, and so on. So some of my work with Pascual Restrepo tries to quantify the extent of technological change throughout the American economy over the last 85 years or so, looking at how these two types of technological changes, automation causing displacement and new tasks leading to reinstatement of labor, have evolved over time. In the period where you had very healthy growth of labor demand, there is something quite remarkable. The displacement was quite fast, indicating rapid automation, but its effects, especially on the labor share, which is, everything here is in the units of labor share, was completely counterbalanced by reinstatement. And as a result, the thick blue line here is the overall effect of technology on labor demand is hovering around zero. But then fast forward to the last 30 years, you see a very different pattern, much faster automation and displacement, much slower reinstatement, and as a result, the thick blue line is heading south. So to put it in a summary form, we've been doing much more automation than before and not much else in terms of technologies. But what's wrong with automation? Well, to understand that, let me actually zero in on one specific automation technology so that it's not like an aggregate, which is hard to make sense of. But let's think of industrial robots, and I'll come back to the South Korean context in a second, where industrial robots have played a very important role as well, somewhat of a different role. But what, in another paper, Pascual and I do, is to look at what the effects of industrial robots have been on local labor markets across the US, in particular 722 local labor markets proxied by commuting zones. So if you have the view that technology just increases productivity and that productivity increases are going to naturally trickle down to workers, which many economists still cling to, then industrial robots are a great case for that because they are generally agreed to be one of the most productivity enhancing technologies, especially within the automation domain of the last several decades. South Korean, German, and American car industries would not be what they are today without robots, for example, neither would metalworking and chemicals. Despite the fact that we do find, just like others, that robots increase productivity, the effects on labor are very different. In places where you adopt more robots, exposure to robots is not exactly robot adoption, but it's very strongly correlated. It's the source of robot adoption. So let me refer to it as places where you adopt more robots. You have much lower employment and also much lower wages, although I'm not showing that here. I'm just focusing on employment. This is showcased by the industrial heartland of the United States, places like Toledo, Cleveland, Beaumont, and of course, Detroit. But the slope that goes through the cloud of points is identical to this line. So actually, these observations are just on the line, but they're not driving the line. So in other words, there is fairly robust evidence and completely independent of the overall decline of manufacturing that places that have adopted more robots have been experiencing much worse outcome for workers. In fact, it's not just wages, but inequality. A more recent work by myself and Pascual Restrepo shows that in addition to large negative effects on wages, thus distorting the income distribution between capital and labor, automation overall, not just robots, but automation driven by robots, numerically controlled machinery, and office software, accounts for the bulk of the changes in wage inequality that I showed you earlier, around 50 to 70%. And one way of seeing that is this chart, which rather than look at the 10 demographic groups, now looks at 500 demographic groups distinguished by age as well as education, gender, race, and place of birth, foreign versus domestic. And it shows that demographic groups that have been most affected by automation, meaning that have lost most of their tasks, and I don't have time to go into how that's constructed, but it's a fairly intuitive measure. Those demographic groups are the ones that are suffering the real wage declines, and this sort of cloud of points, of course, as you can see, fits very nicely along a straight line that explains most bulk of the changes in the US wage structure between 1980 and 2016. So what's going on? Well, clearly there's something about automation that is very different from the classic view of economists about technology. It is boosting inequality, it's depressing wages, it's depressing employment. But is that something we should expect from future technologies as well? And many people think the future is AI, and AI, of course, is potentially very different from robots. Robots were conceived as a technology to replace workers from the beginning. AI had many different theories about them. So perhaps AI could be used for creating benefits, exactly that sort of reinstatement that I was referring to. But recent work by myself, Joe Hazel, Pascual Restrepo, and David Otter shows that AI seems to be going exactly along the same path as robots and other types of automation technologies. Here, by using various different measures, we show that AI activity starts surging in the US around 2016, but it's driven by the blue and the red curves, which are essentially establishments that have more tasks to be replaced by AI. So AI is happening exactly where you would expect that there is going to be replacement. And in fact, consistent with that, if you look at the hiring by these establishments, the blue and the green fall behind the rest. So AI seems to be very much going in the same way as robots. Why so much more automation today than before? I think there are many reasons for that. Let me actually, since time is short, let me talk about three of them. The first is global competition. Global supply chains are now receiving more attention, and rightly so, but they are part of a broader pattern of cost cutting in response to global competition. And of course, for firms, the easiest cost to cut is labor costs. And automation has been very popular with companies for that reason. But even more important, I have argued in my work, is the business model and vision of the big tech companies, whose business model is very much centered on algorithmic automation. And they are influencing not just their own technologies, which is very important because they are the biggest contributors to US GDP, but they are also influencing the technologies of all other sectors. But even more, policy has not been neutral. US tax code, for example, has encouraged excessive automation because capital, especially capital used for automation, is taxed at much lower rates than labor. Labor faces a marginal tax rate of about 25%, taking federal income taxes and payroll taxes into account. Software and equipment have had so many tax cuts for various reasons, which I will not get into, but we can during the Q&A. Now they are facing tax cuts of less than 5%. So that means that there is an implicit relative subsidy to automation of about 20% that the government is providing, which will mean that there will be a lot of automation that's not efficient, but is still profitable for firms because of this distorted tax structure. Well, you might still say good riddance. Automation is great because it's going to bring productivity growth, and if there are some eggs that are broken in the process of making the omelet, perhaps you'll think that's fine. But actually the evidence doesn't support that. I don't have time to get into the micro evidence, but the macro evidence is quite clear. Today, despite a huge number of patents and an amazing amount of enthusiasm from Silicon Valley boosters about the amazing benefits we're getting from new technologies, we are going through one of the slowest periods of productivity growth anywhere. This is true in the US, it's also true around the OECD, with a few exceptions, but very, very pervasively true. And I would like to add that these are not just industrialized nation problems. Some people might think, well, this is an issue for the US, perhaps South Korea with its rapid automation might have to worry, but not so for Vietnam, not so for India, not so for Latin America. But that actually turns out to be wrong, because AI and automation promises to remake the international division of labor. But what's worse, I would say it's the quintessential inappropriate technology. The notion of inappropriate technology, for example, introduced by economists such as Francis Stewart in the 1970s, refers to technologies that are produced in the West or the North, but then are not appropriate to the conditions of the emerging world. In fact, automation in general and AI, if it goes down the automation path in particular, is exactly the wrong technology for the developing world. It saves on low-skilled and semi-skilled labor, which is abundant. In fact, the main human resource of these countries. And it will therefore tend to increase inequality both within these countries, but more importantly, prevent their convergence to middle income status in many cases. And worse, I think, the developing world is completely unconcerned or unaware of these problems. And then finally, the post-COVID world is going to intensify these problems. Many more companies are automating today because of social distancing and labor shortages and other reasons. Now, I've spent quite a bit of time on the first one because I wanted to lay the scene. Now, the rest might be a little bit faster. So let me talk about the second challenge, demographic change. So whatever measure of demographic structure of populations you look at, it's changing and will change much more rapidly in the next 3 decades, sorry. So here, for example, I'm plotting the ratio of the population above 50 to population between 20 and 49. So older workers such as myself relative to younger workers such as Suresh. Well, in all of these cases, that ratio, which was way below 1, is going to start exceeding 1, especially for OECD countries, but also for the world as a whole. Many economists have been very worried about this, and rightly so. It creates both supply side and demand side problems. But despite all of those problems, if you look at the data, there's something striking. Countries that are aging more rapidly, say between 1990 and 2015, or to today, doesn't matter, are not growing more slowly despite these potential problems. In fact, if anything, they're growing slightly faster. Here is Japan, the fastest aging country in the world, and here is Korea, one of the fastest aging countries. So why is it that, contrary to both supply side and demand side prediction of economic theory, we don't see aging create major macroeconomic problems? Well, let's look at the data a little bit more. Here is Germany. Germany started aging in 1990 very sharply, but also look at Germany's investment in automation, for example, by robots. They have been the world leader in automation. Compare them to, for example, the US, which is shown in yellow. And this is Korea. Korea also was actually a very young economy in the young society in the 1970s and 80s, but started aging rapidly around 2000, especially around 2010. And look at Korea's investment in robots. It starts below the US, but now actually exceeds even Germany. That relationship is true pretty much across the board. The more rapidly aging countries, both within the OECD and outside of the OECD, the diamonds are the OECD, are investing more in robots. And my work, both with theory and more detailed empirical work, shows that this induced effect on automation under conditions of labor shortage can actually be powerful enough that these economies can grow more rapidly rather than growing more slowly. So hence, in the second challenge, we are seeing part of the opportunity as well, the right technological adaptation. The nature of work may need to change much more rapidly as this demographic challenge continues. But we are seeing how markets, with some regulation and some government support, as I'll talk about in a second, might actually be adapting to that. But also, you might be wondering at this point that there is a bit of a conundrum here. I've talked about automation as the source of inequality, not so much productivity gain and low wages. And I've also talked about it as a shifter of the economy out of the demographic challenge. Well, in fact, that's exactly right, because there are two phases of automation, good automation and bad automation. Good automation is when automation happens in conjunction with other technological adaptations and in a way that responds to shortages and needs for machinery in certain tasks. Bad automation, on the other hand, is the one that happens in an unbalanced way, just like the one that I showed for the US, without being counterbalanced by other things that helps labor. And it's not happening in response to these labor shortages. At the end of the day, in Japan, South Korea, and Germany, so far as I have been able to understand both the qualitative and the quantitative evidence, the situation looks much more like this figure, where automation is helping existing workers whose comparative advantages are changing because of demographic change and the changes in the structure of industry, not just a pure replacement. And this again highlights a point that I'm going to make in the context of my next challenge as well. The direction of technology is a choice. And it's a choice that companies are making, of course. But once it's a choice, we have to also take into account the framework that government policies and regulations are providing. So regulation of technology is in the background. It's not something that we just have to throw out of the window, either in our models or in our policy discussions. And that becomes even more important for the next challenge, which of course is at the back of everybody's mind today, thanks to COP26, which has not been a huge success in terms of meaningful policy commitments, but it has increased the visibility and the importance of the climate crisis. And part of the reason why I did actually find COP26 disappointing is because it created the impression that businesses were in lockstep working to solve the climate crisis. And that you can get that impression from all of the big energy companies and other companies that were in Glasgow. And you can also get that because there have actually been some advances. So here is data from IRENA showing the cost from various different renewable energy sources. And you'll see that solar, especially, was an order of magnitude more expensive than fossil fuels in the 2000s and even as late as the late 2000s. But today, it is actually more than cost competitive in most tasks. There are still some tasks you cannot use solar for, like airplanes or other heavy fuels. But in most tasks, solar is actually cheaper than coal or gas, or coal at least, if you get rid of subsidies. And competitive if you don't have this, even if you keep the subsidies on coal. So how did this happen? Was it really companies like BP and ExxonMobil, true to their commitments, that have made these advances? No, actually it turns out not the case. It was innovation. Again, underscoring my emphasis on technology. There was a huge technological redirection towards renewables. You can see that, for example, with the US data on patents. These four figures show renewable patents or other broader notion of green patents relative to either total patents or fossil fuel patents. And you see a huge takeoff starting around 2000. And again, it's not just a US phenomenon. It happens in Canada, France, Germany, the UK. I'm not showing the UK. But in all of these cases, you also see a big slowdown after 2010. In fact, the real story is exactly the opposite. Big tech, big energy, big oil is not responsible for this, but is responsible for this. Why? Well, it turns out that the most important reason for the turnaround in patents is that there has been a huge amount of investment in gas. And the decline in the price of gas has discouraged renewable energy investments. So here is time series evidence. Of course, there are lots of problems with time series evidence, but this fits really nicely because it has the up and down. So this is the blue is exactly the curve that I showed you before, and the red one is the natural gas price index. So when the natural gas is expensive, people went and invested more in green technology. But once big energy companies started banking together with shale gas on natural gas, then green technology started suffering from lack of investment. So we are again seeing the issue of the direction of technology. And I think you'll also see in all three of the examples I have indicated so far that the market may get the direction of technology right, for example, as it was doing here, but it can get it wrong as well. Now the market is contributing not to solving, but making the problem worse. And that exactly we saw with the inequality increasing effects of automation in the US and other countries at the beginning as well. Now, I want to come back to democracy now. Because at the end of the day, if all of these problems, the market is not necessarily getting it right, and moreover, there are big players like big tech or big energy that have structured incentives that were going in the wrong direction, one way is to actually hope that democratic process is going to force them. Reforms imposed on firms and tycoons like during the progressive era in the US. That would not have been possible without democratic participation that pushed politicians to go in that direction. But unfortunately, we cannot rely on democracy today because democracy itself is in crisis. There was euphoria about democracy around 1918 after the fall of Berlin Wall. People declared the end of history and in fact, or the third wave of democracy. And in fact, there was about 2 decades during which countries were much more likely to become democratic. But since 2006, we see the opposite. Every year since then, there are more countries moving away from democracy, democracy collapsing, or the quality of democratic institutions declining than the other way around. Why is that? Well, I think it is not unrelated to excessive and rapid automation increasing inequality together with globalization. And in fact, that is the crux of my argument, that the challenges today that we are facing are really threatening the nature of what Jim Robinson and I called inclusive institutions. Inclusive institutions that create broad-based incentives and opportunities are critical both for growth, but also for equitable growth. And throughout history, the main barrier to inclusivity was excessive power of elites via coercion or control of key assets. But I think in the age of automation and some of the other challenges like climate change, we have a new threat to inclusivity. In fact, the labor market is where most people have access to opportunities. If you destroy those opportunities in the labor market, which automation threatens to do and has done to some degree, then this will make institutions, inclusive institutions, more likely to collapse, and democracy very difficult to function. And worse, I think new digital and AI technologies, in addition to their indirect effects through inequality and automation, are also having direct effects on democracy by strengthening corporations and governments against citizens and encouraging misinformation, for example. So all of these put together, I think, create a trial by fire for democracy, especially at the time when democratic institutions are most necessary to deal with these challenges. COVID has also made these problems worse. Trust against democracies is low, especially during the COVID. And then, since time is running short, I'm going a little bit fast here. And then the world order, the global order is unraveling, especially during this time when many of these challenges are actually global, not just climate change, but things like nuclear weapons and treaties on globalization, and inequality, because both technology and taxation are global phenomena. So you cannot think of, for example, the power of capital over labor without taking the international dimension into account. So this is, therefore, what underpins my own thinking on this, that we need a new institutional framework that will bolster both a redirection of technological change and different incentives for firms. And this, I would like to call that welfare state 3.0, both because I think it has to learn from the mistakes of welfare state 1.0 or its reforms over the last 30 years, which haven't worked out so well, sort of creating a somewhat, we did not get rid of the welfare state, but we created a different version of welfare state, which has not been able to deal with the problems that we're facing. And in particular, this welfare state has to deal with international problems such as climate change and globalization, but most importantly, it has to take on regulation of technology, because as I have pointed out, almost all of the problems we're dealing with has a technological element. And in almost all of them, the direction of technology, the direction of technological change has to be rethought, because the market, especially with the big firms, is not necessarily getting it right. So I think when you are calling for new welfare state institutions, there are many issues that one has to take into account. But I think one important one is what this great economist, Frederick Hayek, pointed out. In response to the Beveridge Report in the UK in 1942, which created the blueprint for the post-war welfare states, although welfare state institutions were already in place in Nordic country, in Norway and Sweden. Hayek thought that the Beveridge Report was a second road to serfdom. A new type of totalitarianism could be coming out of that, because the state would have too much power and society would not have the means to check that power. And this is what led to an essay and then to his best-selling book, The Road to Serfdom. And this is my last slide. Hayek turned out to be wrong. And I think we can learn from those mistakes. And one way of interpreting them is through the framework of my more recent book with James Robinson, The Narrow Corridor, where in 30 seconds, here is the diagram that summarizes the book, that you have to think of the power of the state and the elites and the power of society and inclusive institutions, democracy, and liberty more generally can only exist in this narrow corridor where the power of the state and power of society are in balance. So this makes sense of Hayek's concerns. If this balance is disrupted by the state becoming too strong, yes, things can be really bad. But the reason why Hayek turned out to be wrong is because this figure also clarifies with the direction of these trajectories here. There's a Red Queen effect, or what we call the Red Queen effect. When the state takes on more responsibilities, as it did in the post-war era, society can also deepen its political engagement. Democracy can get more active. Civil society organizations can work more. And that strength of society can match that of the state. That is the Red Queen effect, both sides running as fast as each other to keep up with each other. And the key is therefore democratic reawakening, which looks difficult today, but I think is inevitable if we really want a welfare state 3.0 and the redirection of technology and the better incentives for firms and the better control of firms. There is no alternative but to prove Hayek wrong again for the global economy. Thank you very much, and I look forward to Suresh's comments and to the discussion.
예, 감사합니다, 에이스몰리 교수님. 그러면은 그 사회자분과 토론자분께서는 앞으로 나와주시면 감사드리겠습니다.
Thank you very much, Professor. I would like to ask our discussants to please come forward. Yes, we will begin with the discussion session. Dr. Park from KIAF will be moderating the session. Please go ahead.
Okay, thank you. And first of all, I'd like to thank Dr. Acemoglu for your excellent presentation. And actually, we have only 20 minutes remaining, so I'd like to boldly skip the presentation, the introduction and the summary of the presentation, but I'd like to, to briefly introduce the participants. And first of all, you may know him very well already. So Dr. Acemoglu is currently an institute professor at MIT and elected a fellow of many important academic associations. And most importantly, he wrote many important books, and he just introduced in his presentation also one notable book is, the Why Nations Fail. And also he was awarded many, the important prizes and, the medals. And two discussants, first, discussant, Professor Kyung-Soo Kim is a professor of emeritus at Sungkyunkwan University, and he taught at Sungkyunkwan University and the Tulane University, and also he served as a deputy governor of the Bank of Korea. And second discussant is the Professor Suresh Naidu. He is a professor of the economics and the public affairs at Columbia University. And first of all, I'd like to ask Dr. Kyung-Soo Kim for your discussion, and I'd like to ask you to spend about 10 minutes.
Okay, thank you very much. First of all, congratulations for 30-year anniversary, and thank you very much for having me here. Now, I think this is really it's a great storytelling. The details are based on the author's own research, and the proposals he made is being approached is very cautiously. Yes, I recommend that you must read this paper. Now, instead of the summary, let me just briefly what has been done. The challenges have been defined, and tech is identified behind these challenges. And he proposed an institutional build-up at the international level as well as national level, so-called welfare 3.0, should guide digital tech along with the right path. Now, we all know the tech is the key to growth and well-being because the tech drives the productivity. Having said that, the literatures on tech, including this one, lead to speculate that indeed there may be an interaction between tech and democracy. And considering the past 70 years and what is expected to happen in the future, it is conceivable that maybe the causality holds. The green revolution causes aging, which is followed by digital revolutions, which is followed by declining employment, eventually declining populations. Now, Korea is a leader in demographic transformations. Now, she just passed demographic inflection point. As you see in this graph, which is the dependence ratio, after 20 years, then 10 billion workforce will go, and another after 20 years, another 10 millions will go. Now, having said that, from your empirical finding, the question comes to mind, if you control the demographic variables, wouldn't it be by any chance that the Solo paradox will not hold? On inequality, I'd like to address just 2 points. Here, you see the David authors has lots of words here, but they can be summarized by the 2. One is human capital has been scarce and always will be, no matter what. Therefore, investing human capital is top priority. So I'd like to hear your opinion on this. I mean, it's still legitimate in your mind. That is, the paper was 6 years ago, published. And here, I'd like to point out that income inequality exacerbates wealth inequality. Now, if the equity premium is too high, the people will borrow money to invest in stocks. Then the interests go up and stock returns fall. So the premium goes down. So what keeps the people from borrowing money to invest in stocks? Well, the answer, I think, that is in the table, that is who owned the stock. Actually, the 10% has, I bet that was over 80% of the stock is owned. And among them, of course, the top 1% or top 0.1% or top 0.01% always matters. So what's the problem of the bottom 90%? Well, you can find out in the paper in the last one. The bottom, basically what they said is that the bottom 90% owe the debt and the top 1% owns it. And the regulations on tech, it may be easier said than done. The labor-saving technology will reduce the need for company A in country B to outsource the country C. As a result, it will be a benefit to the shareholders of company A and the loss to the workers of country C. So that's what I'm talking about. We have issue of the good and bad regulations. I think that you have something to say about the common prosperity and the SHI's tech regulations. I think that you are very pessimistic. Here you are emphasizing the international corporations, but the reality is that the geopolitical risks are rising. And these are the non-economist prospects and forecasts here. The first 3, these statements are made at the outbreak of the COVID-19, and the next 2 essays is published after America left Afghanistan. I think these 2, especially the 2 essays, are very relevant to what this Professor Asemoglu is trying to say. But I would like to emphasize the last one. The last one is a FDA columnist wrote this essay just before, that was in 2019, which is before the outbreak of the COVID. What he says is that 40 years prosperity in East Asian regions and now under threat, which means that the Korea may be the greatest victim of those geopolitical risks. But anyway, it is a very good paper. I think you should read it. Thank you very much.
Thank you, Professor Kim. Next discussant is Professor Naidu. So, Professor Naidu, you have 10 minutes for your discussion.
Thanks. I will stay under time. Thank you for the opportunity to discuss all of these interesting ideas. So, I won't recap, but, there's 4 major challenges Daron highlighted, and, and then ends with the point that the solution is kind of a set of policies to regulate technology. And I really agree with this. I think one of the, things that we kind of really need to do is sort of take charge of the trajectory of technological progress. And I think Daron's work over the years has sort of really shown how technology is not something that necessarily will just get selected autonomously, but will respond very much to incentives and policies. So my problem with the solution, and which I'll talk about a little bit, is that it's very hard to imagine the political vehicle with the scale, capacity, and legitimacy to implement sort of the solutions that Daron is suggesting. And sort of I'm going to actually take the narrow corridor, I think, more seriously than Daron did in his lecture, and sort of suggest that, in fact, the precursor to any of the policy solutions is, in fact, like a non-policy solution. In some sense, we need the something autonomous, something that's civil society, and something that I think has to transcend the political boundaries and the geopolitical boundaries that we have. So I just wanted to, if you just started with the institutions we actually have to regulate technology in the US, they haven't done a great job. And, there's plenty of blunders around, for example, the rollout of COVID testing in the US. We still can't get reliable, fast COVID tests. Arguably, the biggest input into getting vaccines as fast as we did was just weakening the regulation around pharmaceutical development. And even before COVID, there was some disasters in the regulation of technology, in that we completely let opioids, highly addictive painkillers, loose in the American market with kind of disastrous consequences. And even before opioids, we had other sort of narcotic drugs that were just kind of let into the American population. And behind that is just kind of, I think, as a result of both these mistakes, but also, a propaganda war that has a basis in truth, like all good propaganda wars does. There's like a lot of mistrust of the FDA, and it's one of the many sources of U.S. Vaccine hesitancy, I think. It's, it only has emergency authorization, the vaccine, so people didn't get it. And so it doesn't look like a great scenario for the existing institutions that we have. But I want to suggest this isn't for the libertarian reason that people complain about, which is that the FDA is it's too bureaucratic, it's too captured. I think it's in fact that the FDA, when it is in fact checked by the public, and when there are real civil society groups that are paying attention to what the FDA is doing, it actually delivers pretty good results, I think. And so I'll give an example that Daron might want to think about for his book, is this like AIDS and ACT UP, which was really like a social movement around getting anti-AIDS retrovirals, around defining the standard of clinical care for AIDS, And so it was really a case where like the FDA responded to civil society organizations in a way that kind of really transformed sort of the direction of AIDS treatment and the direction of pharmaceutical development for AIDS. And so I think like the idea here is that drug regulation really fails when there's not really independent civil society organizations looking out for potential harms. And so I think the precursor for the kinds of regulations Daron is talking about is that and particularly at the scale where we're sort of, for technology, it really has to be something at least at a multinational, if not a completely global scale to implement this stuff. And so we're going to need some sort of global civil society. And this is the problem, is that, the audience for the policies that Daron is proposing just doesn't exist. There's a presupposition that like there's some legitimate political authority in some entity that can sort of turn on technological regulation that will do the thing that we need it to do. And I just don't think there's that audience. And and that audience, if it exists, doesn't have the political legitimacy to implement the changes that we need. And so we've kind of got this case where we can have all the great policy ideas that we want, but there's not actually an entity with the tools and incentives to implement them. So we're kind of at something much more fundamental. And so it's like the regulation, it feels to me, at the end of a very long sequence of steps that we need to go through, where it's like we first need to assert some sort of collective ability to manage something before we can, before we kind of throw it to ask it to manage technology. So, I think these are the questions that are kind of behind the questions Daron's asking, which are like, what are the political institutions that we can kind of make work at the transnational scale? So central banking might be one, for example. What are models of democracy that can be marshaled to work at such a scale? What are the coalitions that could hold such things together? What are the technologies that could facilitate the rise of this global political community? And it seems very, very far away. And the experience of the European Union is sort of not promising about exactly how this could unfold. But it seems like we need something like this before we can think about policies. So let me give another story for what we need before policies. I'll just go through this quickly. But Ernst Gellner had this story about how the nation state arose out of a bunch of villages. And he basically tells this story about how, as an economy industrialized, it created this demand for social insurance at a higher level of aggregation than local villages could provide. So let's sort of run with that analogy, which is that in fact, the idea is that we have a whole bunch of parochial, if you will, less educated groups, and then a cosmopolitan set of educated elites, what Piketty calls the Brahmin left, kind of like pooling together, but in deep tension with the less educated groups inside their countries. And so this is why the policy advice being dispensed by academics like me and Daron are seen as a tool of these cosmopolitan educated elites to dominate the latter, not in fact a constructive solution. And so we can't be giving policy advice without having something else to change this political dynamic. So for example, in the GSS, like the non-college educated are deeply skeptical of economics. They're much more likely to believe that economics is scientific, for example. And I think COVID is the worst kind of shock for this. It's exactly the shock that separates people by country rather than pooling them. And so it's just been the worst thing for creating the kind of global political community that we kind of need. So I want to conclude with my little iota of like promise and hope, because I'm and it's kind of like, I'm a big believer in international migration as kind of as the roots of global peace in some sense. It's that and I think international migration actually helps address a lot of the short-term problems in Daron's talk. So it can mitigate international inequality across countries. It can even, when correctly managed with labor market institutions, I think it can also dampen capital labor inequality and push technology towards being labor augmenting rather than labor replacing. It can help address the demographic problems in the advanced countries. It's an important adaptation mechanism for climate change, allowing you to hold sort of a portfolio of real estate, if you will. And in the long run, it also creates a constituency with a vested interest in global social insurance and things. And so this might be sort of, you have to think about something on the margin that might push in the direction of where we need to go. You might think of like expanding like real permanent international migration. So I'll leave it at that. Thanks.
Okay, thank you. And we have used the word, the time allotted for this session. But before I ask Dr. Acemoglu for responding to these discussions, I'd like to add one question collected through internet chatting. Dr. Acemoglu, you mentioned many negative outcomes or challenges caused by automation or wide use of AI, such as decrease of wages and sluggish labor demand, etc. Then what do you have in mind on the possible policy means or tools which can be taken by the government or international society? Okay, I'd like to ask Dr. Acemoglu for respond about 5 minutes.
Okay, I won't even take because we're out of time, but I want to first thank very much Dr. Kim and Dr. Naidu or Suresh for those wonderful and thought-provoking comments. Let me make one response to Dr. Kim, one response to Suresh, and then one response to the question that was posed very quickly. So Dr. Kim, those are all excellent observations, and I completely agree with your point that, and with the point that my colleague, David Otter, colleague and co-author David Otter makes, that human capital policy is also important. But I think human capital policy is only one lever. Economists sometimes sort of instinctively, and policymakers go to the corner of thinking technology has its own path and then the workforce has to adapt to technology. But I think the reality is much more complex. We shape technology, and technology has to meet halfway with the existing skills and competencies and possibilities for the workforce. And I think if we keep on automating, however much human capital investments you do, I don't think you're going to create a fair society just based on excessive automation. So that's why I think human capital policy has to be complemented with regulation of technology. And I think Suresh's comments were completely on target. Those are fantastic comments and very thought-provoking. And I completely share your assessment of the difficulty of achieving something like this. But actually, I would build the sort of global consensus, or I would think that building such a global consensus from a very different path. I think essentially all politics is local, and you have to create local democracy first. So, I did not emphasize it enough, but you are absolutely right. Civil society is key, but I don't think global civil society would be able to achieve much. So the sort of way that I was thinking about it is that you have to get the domestic civil society back in action again. And that is actually quite complementary to regulation. You don't have to wait for first civil society and democracy to get in order and then regulation starts and then you have to deal with global problems. I think they can all be synergistic. So if regulation is attempted, that increases state capacity, that increases the need for civil society domestically to get engaged because regulation has now important consequences and it's a salient topic. And then once you have the local democracy working, especially with global challenges such as climate change, there is a chance that sovereign countries can come together to cooperate under the banner of some global institutions, but you're not going to get a true global democracy, I think, anytime soon, with or without international migration. I hope I'm wrong on that, but so it's half optimistic, half pessimistic. It's pessimistic about true global governance, but it's optimistic that domestic democracy can work and can actually lead to cooperation. And finally, I think in terms of the question from the audience, thank you, that's an excellent question. I think Suresh was absolutely right. You have to think about that together with the political economy of regulation. But let me, since the question was about the technical aspects of regulation, I think the climate change example actually illustrates what can be done. So the huge improvements in green technologies was achieved with actually minimal support from the governments. In the US, very little in terms of carbon pricing, some state level regulation from California, and some dollars for green technologies. In Europe, a little bit more, but also a lot of civil society activism. So I think much more important than, the carbon price, which is very uneven across Europe, for example, has been the fact that consumers have been much more willing to buy clean products or pay for clean technology and put pressure on their employers to reduce their carbon footprint. So I think that really illustrates both the sort of technical aspects. You have to give incentives for companies to use technology properly, and then you have to give incentives for researchers and companies to create the right set of technologies, and all of this needs to be bolstered by civil society participation. So in some sense, the political economy is not separable from the economic implementation. Thank you.
Okay, thanks very much. And with this, I'd like to adjourn this session. And why don't you join me thank three eminent scholars for their excellent presentation and discussion. Thank you.
Thank you very much. We will be back with session 3 at 11:30. We will take a short break. Thank you. We will shortly begin session 3 of the seminar. Ladies and gentlemen, please take your seats. Session 3, the presenter is Professor Maurice Obstfeld from UC Berkeley. Please go ahead.
Okay, well, thank you very much. It's a great pleasure to be here at the 30th anniversary conference of the KIF. I'd like to speak today about the international financial system after COVID. I think that probably my presentation will touch on aspects of both of the two previous excellent presentations. But let me give you an overview. The COVID-19 crisis began with a historic global financial market convulsion. As I'll illustrate, capital account volumes exploded to unprecedented levels, but strong policy actions by advanced economies and counter-cyclical responses by emerging and developing economies pulled the world back from the brink. At the moment, the global financial cycle remains in an expansive phase, but this may turn around when major central banks begin to tighten. Emerging markets will be especially vulnerable to an uneven global rebound. And the world economy cannot remain reliant on exceptional policies in future crises. Here's where international cooperations, stressed in the last presentation, becomes critical. The world economy needs to build financial market resilience, and this needs international cooperation. Let me illustrate some of the trends in international financial markets leading up to the recent crisis and during the recent crisis. Of course, the last crisis of this magnitude, the global financial crisis, occurred barely a dozen years ago. And it was preceded by an expansion in global financial market activity, as illustrated in these data, which show the ratios of the average of external assets and liabilities to GDP for both advanced and emerging economies. You can see the rapid buildup, primarily in advanced economies, which were the locus of the last crisis, up until the latter part of the first decade of this millennium, and a much slower pace for advanced economies since then, a flat level for emerging markets. Another metric that we might look at is not these stocks, but flows of transactions. In this chart, I show a partial picture of the US financial account based on transactions between US and foreign residents in US and foreign long-term assets. So what this chart is omitting is short-term assets like treasury bills, things like bank loans. But even so, you can see that transaction volumes have increased markedly over time. They increased dramatically up until the global financial crisis. They fell back and then increased again and reached truly unprecedented levels in the turmoil around the March 2020 month and afterwards. To put these pictures in a little bit of perspective, in these charts, Series A is gross U.S. resident sales of U.S. assets to foreign residents. B is gross U.S. resident purchases. So A minus B is the capital outflow from the U.S. as traditionally, the capital inflow to the U.S. as traditionally measured. C minus D is the capital outflow. So these are often called gross capital flows. They're not actually gross. The current account deficit is the difference in these differences, and it's a relatively small number. But if we look at these gross transactions, the levels are astounding. In the turmoil of the spring of 2020 and afterwards, these reached a level of $6 trillion a month. US GDP is on the order of $2 trillion a month. So these are transaction volumes that are 3 times GDP at their maximum. And they raise the question of A, are there too many financial transactions? Is there too much trading? And B, how can the infrastructure support these incredible volumes of trades where small differences can lead to large swings in conventionally measured capital inflows and capital outflows? Particularly for emerging and developing economies, there was a sharp retraction of portfolio inflows in the fall of, in March of 2020. And you can see that very clearly here in this chart. And it was followed by an equally impressive inflow to emerging markets that the chart also makes evident. So incredible volatility in these markets. A longer span of data for Korea are available. And you can see that Korea is very much a country that is buffeted by very volatile capital inflows. This happened particularly in March of 2020, but it is a standard feature of the Korean balance of payments. Now, these swings in capital flows could have had much more negative effects than they did on emerging markets, but for a number of factors. One of these was the fact that emerging markets themselves were able to mount unprecedented countercyclical policy responses. These consisted of interest rate cuts, QE purchases, FX intervention, looser reserve requirements, including those discouraging capital inflows, which had been in place in many countries, liquidity enhancing operations, which also encouraged bank loans to businesses, macroprudential easing, including relaxed capital requirements, enhancements to market functioning, and fiscal responses, which were aided by low global interest rates, which created fiscal space. And that fiscal space, in turn, had a lot to do with the very expansive policies that were adopted in advanced economies, especially the US. In addition, more targeted measures by the US helped, as I'll illustrate in a moment, in particular Fed foreign exchange swaps for selected countries. If you look at the Korean policy response, it illustrates these patterns. Unlike in past emerging market experience, Korea was able to cut its interest rate dramatically despite a depreciating exchange rate. You see most recently, the BOK has begun to tighten in response to inflation pressures. It tightened in August, and then it delivered a second Thanksgiving gift last Thursday of another 25 basis point hike. Central bank domestic assets shot up. Credit to the private non-financial sector, instead of declining, as was the case in the global financial crisis, increased somewhat. But all of this global liquidity, as was mentioned at the outset of this conference, has fueled stock market appreciation around the world, not least in Korea, as you can see here. And this is one of the challenges in exiting from the current monetary accommodation. I mentioned the Federal Reserve swaps, which were given to a number of Pacific area countries besides Japan, Korea, Singapore, Australia, and New Zealand. And this chart shows the drawings from those swap lines, which were relatively small in the grand scheme of things. Korea also has ample international reserves, but are really important for signaling, as illustrated by the path of the exchange rate. The Korean won depreciated significantly up through March 19th. Korean markets closed, and the next day in the US, March 19th, the Fed announced the swap line. And you see right here the immediate appreciation of the won after that announcement. So these swap lines have been enormously important. Does this all indicate a pivot point for countries like Korea exposed to capital flows? As I said, the macro response to COVID-19 was a welcome countercyclical response, unlike often in the past. Interest rates could be cut even as currencies depreciated. This, to my mind, showed the great value of exchange rate flexibility in a world of global financial instability. A number of authors have discussed this response, and it raises the question of whether we're in a brave new world for more mature emerging market economies on a par with those that the advanced economies can follow. We should remember that emerging markets were in a particularly strong cyclical position when COVID-19 emerged. They were able to build on recent track records of inflation credibility, stronger policy-making institutions, and actually impressive growth in policymaker skill, which I think has been an important factor over the last couple of decades. And they surfed on a wave of incredibly aggressive monetary and fiscal actions in advanced economies, driving interest rates to low levels that were also expected to persist. The pandemic, however, has stretched emerging market finances and has caused scarring that could worsen over time. Emerging market economies had to fiscally support their economies, make unusually high health expenditures. Their revenues fell in the recession, even as a share of GDP. The lockdowns did take a toll. And there will be more supply chain driven inflation pressures going forward, which will challenge central banks to maintain the hard-won credibility of the last couple of decades. In addition, financial stability risks may be higher. Much of the government debt that was issued by emerging markets resides in emerging market banking systems. And this raises the possibility of a doom loop type dynamic when interest rates rise and the values of these government debt securities fall. Credit easing measures taken during the crisis may confront emerging market authorities with harsher trade-offs later when interest rates do rise. And this is a theme that was present in Professor Beck's presentation earlier, which I will cite even though he is enjoying a welcome sleep at the moment. The same could apply to macroprudential easing measures. A huge threat hanging over the global economy is the fact that in addition to more limited fiscal space, the distribution of vaccines remains very uneven. You can see that in this chart, with Africa being a particular weak point. Now, this will not only increase the vulnerability of some countries, but will also possibly lead to the emergence of new variants. And I have to say, I put this slide together before Omicron emerged, likely out of South Africa, but it very well illustrates the problem that will continue to confront us until there is a global cooperation in getting vaccines where they are needed. And perhaps even more importantly, as time goes, providing support and infrastructure to countries for carrying out vaccinations. South Africa actually has a lot of vaccines, enough vaccines, but it can't get them into arms, partly because of infrastructure problems, partly because of vaccine hesitancy, which grows out of institutional failures on a global scale, not unlike those that Professor Naidoo mentioned in his presentation. To give you some idea of the public debt challenge, I show in this chart on the right-hand side the evolution of public debt to GDP ratios in advanced economies. On the left-hand side, that in emerging regions. Typically, emerging regions have been able to sustain lower debt levels because of more limited revenue collection capacity, among other factors. And so the run-up in debt levels in emerging markets, even if it leaves them at levels below those in the advanced economies, is a cause for concern. And probably the worst performing region in this respect is Latin America, where big countries like Brazil, Argentina pose particular threats. You can see this more clearly by looking at percent increases in government debt to GDP ratios, which are comparable in advanced and emerging economies, are biggest in emerging and developing Europe, which, however, had exhibited quite a lot of fiscal restraint in the years before. I mentioned at the outset the global financial cycle as a potent factor. This has been a theme in international financial research for nearly a decade now, since an important paper by Ellen Ray at Jackson Hole in 2013. And it refers to the tendency of global asset prices, commodity prices, capital flows, and leverage to move in sync, notwithstanding countries' attempts to manage independent monetary policies aided by flexible exchange rates. Silvia Miranda Agrippino and Ellen Ray have developed one index of the global financial cycle, and I chart its monthly average here over many years with the growth rate of output in emerging and developing economies. The coherence, to my mind, is pretty substantial. There are other measures which have been developed since then. I don't want to spend a lot of time on that. Miranda, Agrippino, and Ray base theirs on asset and commodity prices, but there are other measures which build in quantity variables such as capital flows, other quantity variables, which try to separate out commodity prices from asset prices. Suffice it to say that these are correlated with the original Miranda, Agrippino, and Ray measure, and pretty much point to the same dynamics and have the ability to explain large fractions of variance of asset prices and gross capital flows. One critical feature in understanding the global financial cycle, and Hyun Shin at the BIS has been a pioneer in demonstrating this, is the role of the dollar's effective nominal exchange rate. In many ways, the dollar's nominal exchange rate is kind of a sufficient statistic for the global financial cycle. And this points to the fact that a number of researchers have found US monetary policy to be a major determinant of the global cycle. Not surprising in view of the US importance in global financial markets and in international trade, and the key importance of the dollar in the global financial system as a reserve currency, as a unit of account, as a store of value, and as a vehicle currency, as a funding currency. Again, here I graph the dollar against the Miranda, Agrippino, and Ray Global Financial Cycle Index. Again, when the dollar strengthens, the global financial sector, the global financial cycle plummets. And so a weak dollar is associated with expansive global financial conditions, a strong dollar with global financial contraction. The dollar's role can be seen in other variables. You see it in commodity prices. Here I show the relationship between trade volume growth and the nominal effective dollar. And again, the correlation is pretty striking. So we have to be worried about what is going to happen globally and particularly to emerging and developing economies when the Fed finally raises interest rates and when global financial conditions tighten compared to the very expansive position we are in now, one in which it's pretty easy for emerging markets to borrow and capital flows have been generally strong. Well, rises in advanced economy inflation are advancing, in all likelihood, the date at which the US Fed is going to tighten. This is going to stress emerging and developing economies' public finances, given their higher debt levels, and possibly lead to crises. Dollar appreciation will be a potent transmission channel here. My paper details a number of the channels, but one of them is simply that emerging corporates have very big dollar debts. As I said, currently, the global economy is in an expansive phase, but if the central banks in advanced economies tighten, and especially if they do so when they are already behind the curve and feel a need to tighten abruptly, that is going to be a major problem. My discussant, Professor Kalemlios Khan, has documented how US tightening raises risk premiums in emerging markets. Hopefully she will say a little bit more about that. And the supply chain driven pressures that that all countries are facing is going to be an additional challenge because emerging and developing economies will want to not give up the hard-won gains of anchoring inflation expectations at relatively low levels. So in the last few minutes, let me come back to the point I made at the start about enhancing the financial system's resilience. I found the discussion of international cooperation at the end of the last session really fascinating, and I wish we had time to go into that more. Perhaps in the panel tomorrow we could talk about that. But one of the areas where cooperation has actually made some inroads, not perfect, but I think it's one of the relatively stronger areas, is actually in the international financial sphere. And so it's not idle to think that the global community could come together to enhance the resilience of the international financial system. To come back to Professor Beck's presentation, the regulation of non-bank financial institutions is really a key challenge going forward. These have become increasingly big drivers of capital flows. They played a big role in the sudden stop in March 2020, as well in the reversal. They're playing a big role in the current inflows to emerging markets, but they're lightly regulated or unregulated compared to the banks. After the global financial crisis, we did a lot of work on enhancing bank regulation. It's far from perfect, but measures like Dodd-Frank in the US, like the single supervisory mechanism in the EU, like Basel III, did tighten regulations. Now you can ask whether there are unintended negative consequences of that in the form of diminished liquidity in some segments of markets. But one way to note that they have been effective is the unintended consequence of driving activity to the non-bank financial sector. And so it's really critical that the global community get a handle on this. And the Financial Stability Board is conducting an exercise, a cooperative global exercise in thinking about how regulation of the non-bank financial institutions can move forward. Another area which needs reform, and this will largely be up to the US, will be to reform the markets for US treasuries. Now, this should actually be viewed as a global imperative because the US Treasury is the world's safe asset. So this is a matter of global significance. And we saw in March of 2020 a dash for cash as even central banks trying to liquidate treasuries to get cash faced problems of illiquid markets. So there are a number of studies and proposals about how to reform the treasury market. One of the most persuasive proposals is to introduce central clearing for US treasuries. The global financial safety net, which centers on the IMF, needs strengthening. The 16th quota review of the IMF's capital structure is ongoing now, and it's important that that be completed and that IMF resources be enhanced. The IMF's efforts to extend its liquidity provision to emerging markets were not entirely successful. It instituted a liquidity swap line, which the IMF board had rejected in 2017, but for reasons which have long been discussed, no countries have taken advantage of that, unlike the case with the Federal Reserve's swaps. So that's an area that needs rethinking. The use of capital flow measures complementary with monetary and macroprudential policies needs rethinking. This is an area where Korea has instituted some very useful regulations on banks' foreign currency liabilities, for example. But there are continuing disputes with the IMF and with a number of East Asian countries about the role of capital flow measures versus macroprudential measures. Hopefully the IMF is now rethinking its attitude, and we can take a more productive view towards these types of policies. Another area of potential concern is that liquidity problems for some countries may turn into solvency problems, but the framework for sovereign debt restructuring remains inadequate. The G20 is a locus for this type of reform. It is moving to Indonesia for its presidency in the coming year. So hopefully there can be some action here. Its major initiative was the so-called Common Framework for Debt Treatments Beyond the Debt Service Suspension Initiative. But this remains totally voluntary for the private sector. Unfortunately so, despite the great advance of China agreeing to participate in this process. And exchange rate flexibility, as I said, remains essential. Let me wrap up with one comment, which will reflect something you've already heard today. A famous golfer once said that golf is a game of luck, but the more I practice, the luckier I get. Similarly, macro policy success in the recent crisis has required a lot of luck, but the more we prepare, the luckier we will be. And there's certainly room for preparation. So let me stop there and stop my share.
Thank you very much, Professor Obstfeld. I would now like to ask our moderator and discussants to please come forward. We have Dr. Lee Myung-hwal from KIF to moderate session 3's discussion.
And also good evening, all the participants from the abroad. My name is Myung-hwal Lee. I'm the Senior Research Fellow at the Korea Institute of Finance. I'm very pleased to take a moderating role for this session. As you know, the theme of this session 3 is International Financial System after COVID-19. And I welcome all of you to this session. Now it is my great honor to introduce to you the world-renowned scholar who gave us a kickoff presentation for this session. Our speaker, Professor Obstfeld, is the class of 1958 professor of economics at the University of California, Berkeley. And from 2015 through 2018, he served as economic counselor and director of research at the International Monetary Fund. And during 2014 and 2015, he was a member of President Obama's Council of Economic Advisors. Now I would like to also introduce our distinguished two discussants. Our first discussant, Professor Kwan-ho Shin, is a professor of economics at Korea University. He was an assistant professor at the University of Kansas, and he served as a member for the National Economic Advisory Council from 2010 to 2011. And our second discussant, Professor Kalemi Wezkan, is Neil Moskovich Endowed Professor of Economics at University of Maryland, College Park. She held a position as lead economist and advisor at the World Bank during 2010 and 2011. She also served as the senior policy advisor at the International Monetary Fund during 2019 and 2020. And now I invite Professor Shin for the discussions, followed by Professor Kalemi-Welsken. Each discussant will have 10 minutes for the discussion. Professor Shin.
Thank you very much, Chairman. And I also would like to thank the organizers for inviting me to the 30th anniversary conference of KIF. And I'm very honored to discuss this very interesting paper. I really enjoyed reading it. And I basically agree with most of the views presented by the Professor Opsfeld, especially I agree with his conclusions that strong policy actions by advanced economies and countercyclical responses by EMDs pulled the world back from the brink. And the second conclusion that the global financial cycle is in an expansive phase, but it may turn when major central banks tighten. And finally, EMDs will be especially vulnerable, maybe this is also true for Korea, to this uneven global rebound. So my comments will be basically mostly complementary, but based on the Korean's experience. So basically, I will explain my views on 3 areas. First of all, I'll talk about Korea's experience of countercyclical policy responses. And second, I'll also talk about Korea's experience of capital flows and exchange rate in March 2010, when the COVID-19 crisis broke out. And finally, I'll explain lessons learned from the COVID-19 crisis and challenges ahead from the perspective of Koreans' experience. So this shows the Korea's countercyclical policy, monetary policy response, which was also showed by Professor Opsfeld. And before the COVID-19 crisis, the policy rate was at 1.25, and then rapidly lowered to 0.5%, which is the historically lowest level. But recently, BOK decided to hike the interest rate actually twice. The graph shows just one time increase, but a few days ago there was another hike. And I believe that this the interest hike is related to these 2 graphs. The graph in the left shows the household debt to disposable income, the orange line. And the blue line is the growth rate of household debt. And you can see that after the COVID-19 crisis, they both of them increased very rapidly. And the second panel on the right shows the percent increase in housing prices. And it also shows that recently the housing prices are increasing very rapidly. So this is the main reason behind the recent high interest hike by the BOK. Then
a question arises whether it is appropriate for monetary policy to respond to this kind of phenomena. They called financial imbalance or financial instability. And this kind of debate actually dates back to lean versus clean debate, even before the global financial crisis. And there are various views, but in principle, the majority views is that macro-prudential policies should be first line of defense. In Korea's case, actually, inflation rate is around higher than recently 3%, but the core inflation rate is even lower than 2%, even 2%, and BOK actually projected that inflation rate next year is 1.7%. So when you think of the just inflation, there's not much needed increase in interest rate. So the main the motivation of increasing the policy rate recently is to respond to this kind of financial instability. But after global financial crisis, many countries have tried to develop macro-prudential policies exactly to respond to these kind of problems. And that should be implemented before any movement of the monetary policy. But the problem is that macro-prudential policies may not be appropriately conducted, maybe due to some political reasons or many other reasons. In that case, monetary policy response may be needed. In Korea's case, the Bank of Korea Act was amended in 2010 to include financial stability as a goal. But the Bank of Korea does not have any tool to respond to this kind of financial instability. And in Korea, macro-prudential policy is conducted by the Financial Services Commission, and that is not properly coordinated with monetary policy. And this creates the lots of problems in the macro and macro-prudential policies. The second comment is on Korea's experience of capital flows and the exchange rate in March 2010. And that at that time, the exchange rate again increases rapidly to, I believe, over 1280. And this is related to this acute phase of financial stress, which is indicated by this dollar funding costs in foreign exchange market. And that is especially pronounced by the foreign exchange swap basis points. And you can see that on the right-hand side, the orange line is the Korea's case, and that, in particularly in Korea's case, that swap basis widened very rapidly around March 2020. And actually, after the global financial crisis, we learned some lessons. And the basic lesson we learned from the global financial crisis is that you can see from this figure, the red line is the exchange rate. And the exchange rate movement, especially around 2008, is closely related to reversal of capital flows, especially the bank borrowings. So bank borrowings in short term, that was a major culprit of this crisis around global financial crisis. So after seeing this, the regulators actually focused on the banking sector and introduced many regulations such as the bank levy. And you can see that regulation was somewhat successful in the sense that the red line, which is the short-term borrowing by the bank, is substantially decreased after global financial crisis. Instead, the blue line, long-term borrowing, a little bit increased. But another problem arises because now the banking sector is regulated, then the capital flows actually coming in different paths, and that was the bond markets. So bond markets are expanding, and especially the government bond market is rapidly developing. And this actually created another problem, not Korea's case, but in many other emerging economies. Recent BIS study shows that even in the bond market, there was capital reversal when the exchange rate changes a lot. So the Professor Ostfeld actually suggested that floating exchange rate is helpful, but in that case, because of the huge change in exchange rate, the foreign investors actually suffered lots of loss, and that was the reason they withdrew capital from bond market, and that is coined by Hyun Sung-shin at BIS as the original Shin redux. And recently I wrote a paper with Hyun Sung-shin, and we reviewed macro-prudential policies in Korea, and we saw that from our study that Korea is increasingly become a creditor to the rest of the world, and that creates another problem. For example, during the COVID-19 pandemic, security firms that were under pressure to meet increased margins associated with their equity derivative positions, namely ELS. That was a major problem we had. And another problem was the bond market investment in foreign countries. Those institutions, such as the insurance companies, invest in foreign countries, but to hedge exchange rate movements, they buy foreign exchange rate hedging instruments, and that increase in demand also created problems around COVID-19 crisis. So, what are the lessons we learned from this COVID-19 crisis, and what are the challenges ahead from the perspective of the Korea's experience? First of all, the importance of having a coherent overall macro-financial policy framework that incorporates both monetary policy and macro prudential policy will be key. But in our case, the role of the central bank that has an explicit financial stability mandate needs to be further clarified with the view to reconciling the mandate with the appropriate tools. So at the moment, they have the mandate, but lacking appropriate tools to respond to financial instability. And the experience in March 2020 also showed that the limitation of approach that just focuses on banking sector. So our macroprudential policies are designed to regulate just banking sector. Bank levy is an example, and LTV, DTI, for domestic housing prices, that is also focused on the banking sector. But in 2020, the role of non-banking financial institutions, such as the security firms, insurance companies, that played very important role to create the crisis. So that kind of regulation should be incorporated more effectively into the overall design and management of macroprudential frameworks. And finally, Korea is changing its role as increasingly being a creditor and an investor in global markets. And that means the policy also needs to evolve with this changing landscape. So let me stop here. Thank you.
Thank you, Professor Shin, for detailed discussion. Now, I would like to invite Professor Kalami Uesken. Professor?
Thank you very much. Let me share my screen. Can you see the full screen? And can you hear me? Okay. All right, great. So first of all, thank you so much for inviting me. It's a pleasure to be here at the 30th anniversary. Let me start with a summary of this very nice paper by Murray Opsfeld. It is a very good description of international financial markets and the place of emerging markets in those markets, basically in terms of how emerging markets contribute or how they got hurt. All that is covered very well, both before and after COVID. So it is a very good to-go piece if you want to understand these issues. So there's so much in the paper, but the key theme that is coming out is that emerging markets are going to be in a vulnerable spot during the recovery from COVID-19. There are several reasons for that, but they are going to be vulnerable. At the same time, as policymakers, we know what to do. We did some of this as a response to COVID, but obviously they were short-term emergence responses, as Murray put it. So here we have a chance now to do much better, and we cannot wait for next crisis to take more medium to long-term reforms to improve the resilience of the international financial system. So first of all, as you can see on the slide, I couldn't agree more. I agree with everything in this paper. There is really nothing to disagree here. So what I would like to do is I'm going to highlight the key mechanism that Murray underlines. Basically, how do we think about linking global shocks to emerging markets? And that global shock can be a financial shock like the Lehman collapse, or it can be a shock, health shock like COVID. So I'm going to kind of think a little bit about that whole spillover process, providing a little bit more figures, but basically they will be saying the same thing Murray already pointed out. Then I'm going to have a look at capital flows, very much the same data Murray is looking at, but I'm going to have a different take here, and instead of looking at the total capital flows at the country level, to emerging markets or to advanced economies, I'm going to look at these things at sectoral level based on the borrowing sector. And I'm going to compare what happened during previous crises and what happened during COVID to understand the vulnerabilities maybe a little bit better. And if this can give us a metric so that we can be ahead of the cycle, financial cycle as policymakers. And then I will conclude with policy implications. Basically, I'm going to be reiterating the ones that Murray already said, but I'm going to use some colorful charts to just highlight all these important points and policy implications Murray already mentioned. Okay, so the linkages from global shocks, global financial conditions, and U.S. monetary policy to emerging markets is what I called international risk spillovers. So I documented this, as Murray also referenced to that work in my 2019 Jackson Hole paper. And why this is important, and again, this is everything in terms of, U.S. dollar, as Murray said, U.S. monetary policy, global financial conditions. Obviously, these are, we are relabeling the same thing, right? Why U.S. is centered there? Because it is about global financial conditions, it is about the dollar, and U.S. is the country that basically has a control over these. But how these conditions transmit to emerging markets is really about changing risk sentiments of international investors. Because if you look at this transmission, it is not the same for Mexico, Brazil, Korea, and Switzerland, right? So there is going to be a big difference between advanced economies and emerging markets, although they are going to be affected from this. Going back to global financial cycle figures, the Murray showed, everybody's asset prices, everybody's capital flows are going to be affected from, the dollar index, U.S. monetary policy, global financial conditions. That's true. But when you go more granular in the details, emerging markets are going to be way more risk sensitive. Okay, so there is going to be this emerging market specific risk sentiment of the global investors, and that's going to go up even during more than advanced economies during bad times. And that's going to be very important because that's going to put emerging markets even in a more vulnerable spot where counter-cyclical policy may not just work on its own. Okay, so what are the channels here? So the channels of international risk spillovers, and Murray mentioned all these. I just want to put them here again on this slide so that we are very clear on what is coming from the lender side, what is coming from the borrower side. Because from an emerging market perspective, there's so much you can do about, affecting JP Morgan's behavior, the lender, right? But there is a lot you can do about your own domestic banks, which is about macroprudential policies. So it is important in that sense to understand this channel of international risk spillovers coming from the lender side and the borrower side. So the lender side, of course, global banks' funding costs and balance sheets, right? So the easier funding is for global banks, the stronger their balance sheet, then they are going to invest more in emerging markets. They are going to take more risk. Of course, the second layer of that is whoever the domestic intermediary in the emerging market, and most of the time it is domestic banks, but obviously their funding costs and balance sheets are going to be important, and they are going to be very tightly linked to the global banks' funding costs and balance sheets. These are both lender-side mechanisms, and that's going to be important because lenders are going to be the pricing the asset here more than the borrower. And on the borrower side, there obviously corporate balance sheet weakness strength is going to be very important, as Murray said, and that's going to be dependent on how much dollar debt you have in your country and how much of that is unhedged, right? So in general, when you look at big corporations in countries like Korea or, Brazil or, Turkey, you see that they are going to be mostly hedged, either because they are big multinational corporations, they are exporters, they are going to have a natural hedge, or they do bother to go and get a derivative contract on that dollar debt exposure. Unfortunately, this is going to be not the norm, but outliers, because most of the economy, when we go to the small and medium-sized enterprises, which most of the emerging market economies are composed of those firms, and that's what matters for the macro economy of emerging markets, they are going to be unhedged. They will have dollar debt, because borrowing in dollars is cheaper. There is going to be a UIP violation at the firm level, and they are going to be borrowing in dollars, even from their own domestic banks, because that's just cheaper. And they are not going to hedge it. They are not going to acquire a derivative contract to hedge it because that's costly to do so. They are not a giant exporter or a multinational, so they cannot do that. So that's going to be an important vulnerability on the borrower side, on the unhedged dollar debt on the corporate balance sheet, which is going to be one of the channels of international risk spillovers. Now, I'm going to argue that if you look at this, what I call UIP risk premium, UIP is the uncovered interest parity condition, and we know this never holds in emerging emerging markets. So in that sense, it is not new. But what I'm going to show in the next slides is this UIP risk premium is actually fluctuating with all these important indicators Maury mentioned, right? US monetary policy, global financial conditions, global risk aversion. UIP risk premium in emerging markets actually move with that. And in that sense, this is going to be a very good barometer of international risk floors. And in fact, I'm going to argue that emerging market policies should aim at smoothing this risk premium. And this makes the case for flexible exchange rate is even stronger. So I fully agree with Maury that, we do need flexible exchange rates. That case remains strong. But here there is a separate role for flexible exchange rate than the standard expenditure switching role, that they absorb these risk premium shocks. And they really help the monetary policy trade-off by getting rid of this UIP risk premium, so you don't really have to do anything. So basically, a flexible exchange rate frees the hand of the monetary authority to go and target inflation, output stabilization, and all that. And I'm going to be clear on that. But this UIP risk premium concept and how it moves in emerging markets with the global shocks is going to make the case for flexible exchange rate strong. Okay. So here is a figure, a similar figure to Maury's figure, only for emerging markets. So the very strong negative correlation between the risk sentiment index, here it is WIX dotted line going back to 1996, and the solid line is the total inflows to emerging markets. There is a strong negative correlation between them. Now I'm going to go one step down in granularity and look at sectoral flows. And sector flows is going to move with VIX too, but more so the private sector flows and less so the government sector flows. And that's going to be very important. So the traditional way we look at capital flows is by asset class, right? We look at portfolio bond flows, portfolio equity flows, FPI, other investment flows and all that, which is of course very useful. But another alternative way, and also very useful way, is to separate capital flows by sector. So, and we did this both for emerging markets and advanced economies. And when you look at the emerging markets here on the left, just take the total capital flows and separate, you see that these three sectors are going to have equal shares, right? Banks in red, corporates in blue, and sovereigns in green. They are going to have around 35% each among all total capital flows. So that looks good. However, when you go to loans and bonds, then the picture changes, right? If you look at the loans, the banks and corporates are going to have a lion's share here, the middle figure, in blue and red. And the sovereigns, they are going to have much less because sovereigns don't borrow in loans, they borrow in bonds, right? And that's exactly what you see in the last figure here. When you look at bonds, for emerging markets, again, most of it is going to be sovereign borrowing, right? Almost 70% of these bonds are going to be sovereign, not the corporate sector, unfortunately, and not the banks. So this is going to be very important when we try to understand the vulnerabilities related to the borrowing sector and related to the dollar factor that Maury mentioned, right? Because we all know very well there is a tendency on emerging market sovereigns borrowing local currency the last 20 years. So if you just look at bonds, you are going to miss the entire dollar exposure because that is going to come through loans, cross-border loans of corporates and banks. They are going to be more in dollars, right? As opposed to the bonds, sovereign bonds, which is mostly going to be in local currency. And this is going to be very important when we try to understand what is going on around crisis times. So here, this is a little bit blurry, but let me walk you through this figure. So I'm going to have three figures here again. The first figure is going to be global financial crisis. So it is going to be around 2008, Lehman collapse. The second figure is May 2013, taper tantrum, emerging markets. And the last figure is going to be COVID. And this is all emerging markets. And you see that having a sector look is going to actually teach us a lot of new facts. During global financial crisis, what is going down, this is every color is a capital flow to that sector. What is going to negative, that means foreigners are going out. So negative inflows means foreigners are taking their money out, as Maury clearly explained at the beginning of his presentation. In the first figure, during Lehman collapse, global financial crisis, the money getting out of the banking sector. So the foreigners, JP Morgan of the world, who invested in the domestic banking sector of Korea, they take their money out, and then the corporate sector. It's also getting out of the corporate sector in emerging markets, okay? So that's something very much expected. This was a financial crisis. When you look at taper tantrum, it is also a similar figure, right? A lot of money came out of the domestic banking system of emerging markets. Why? Because foreigners are heavily investing those because domestic banks borrow from foreigners, and that is coming out during taper tantrum. That's the middle figure. Now, when you go to COVID, you see something very different, right? So this is COVID. This is 2020, that acute phase of COVID, and you see the blue going down negative. What is blue? Public. So at the beginning, that March-April period, there was this huge dump of sovereign bonds of emerging markets. So capital flows coming out of the emerging market sovereigns. That's this negative blue here. And then later in 2020, towards 2021, out of the banking sector, right? Banking sector comes later. First, it was the sovereigns. Why? Because that was a huge uncertain moment. And of course, these are local currency sovereign borrowing was the riskiest class from the perspective of foreign investors, because this is the thing that is going to depreciate most quickly, right? This is in local currency. So in that sense, it's going to be extremely important if we want to understand the vulnerabilities in terms of currency exposures and sectors. We really need to be looking at these things by sector. Okay. Now let me go back and tie this to the U.S. monetary policy, emerging market monetary policy response, which we saw an extreme counter-cyclical response during COVID, as Maurice said, and how this needs to be risk-free. So this is from my Jackson Hole paper, and this is going to tell you something very interesting. First of all, what I want to do here is to understand a surprise contractionary shock to the U.S. monetary policy, which is something that we might witness in the next coming months if Federal Reserve decides to tighten. And why it is a surprise? Because this is the state of the art in the literature, where you try to get the part of the U.S. monetary policy that is not endogenously responding to the U.S. economy. So how we measure this by looking at the changes in Fed fund features around the 30-minute window of an FOMC announcement. So if you look at that, what you see on the left is a huge increase in risk premium. This is emerging market government bond spreads. There are 55 emerging markets here. So this is obviously the average. 55 emerging markets, and this starts in 2000, okay? After 2000, 55 emerging markets and quarterly surprise contractionary shocks to the US coming until COVID, stopping at the end of 2019. You see this huge increase in these short-term spreads. This is very important. This is not term premium. This is not the long end of the yield curve. This is government borrowing less than 12 months. Okay, these are less than 12 month or 12-month government bonds, emerging market external borrowing, and those spreads vis-a-vis the US increases a lot. So with a 1 percentage point, 100 basis point contractionary US monetary policy shock, you go up to 3 percentage point increase in the short-term government bond spreads in emerging markets, in spite of the fact that they are running counter-cyclical monetary policy. So the right figure is actually telling you that although we had all those emerging markets, the famous Indonesia case in 2013 taper tantrum, famous Turkey case before, even we have all those famous emerging markets that hiked rates, the average reaction since 2000 actually for emerging market was easing. So in that sense, this sense that, during COVID, maybe this happened, the first time is not entirely correct. They were doing it all along. It's just that COVID, they all did it at the same time, so it was very visible. Before, since 2000, actually pretty much average emerging market and median emerging market reacting to US contraction monetary policy shocks with a counter-cyclical response. Why? Because this is not the 80s and 90s anymore, right? This is 2000s and after, the last 20 years. We have more floating exchange rate regime, much better monetary policy making in emerging markets, and they were doing the right thing. However, here's the catch. Even they were responding counter-cyclically, they cannot prevent the increase in the UIP risk premium, right? If I plot here now the advanced economies, you will see that this doesn't happen at all. UIP risk premium does not respond in advanced economies at all. They also do a counter-cyclical monetary policy, but the UIP risk premium doesn't respond at all. In emerging market, in spite of the counter-cyclical monetary policy, UIP risk premium responds, government bond spreads respond, okay? So why that is happening? Let me go through that, and then I will conclude. That is going to be very clear when we look at what this UIP risk premium is. So the bond spreads, I showed you, of course, only this interest rate differential part. UIP premium is going to have two parts, right? The interest rate differential in a given country, say Korea, minus the US, plus the exchange rate adjustment term. This, if you write this with minus, this is the expected depreciation in the exchange rate, when S is defined as local currency per dollar, the higher S means depreciation. So that's the UIP premium, right? If these two terms cancel each other, then UIP premium is zero. If they never cancel each other, so that we always have a positive actual UIP premium. So this term is always bigger than this term in emerging markets, okay? I'm writing this from the perspective of domestic economy and emerging market, and foreign is always going to be the US. So this is from our work on 5 facts about the UIP premium. The first interesting fact is if you look at the top figure, UIP never holds in emerging markets, okay? UIP holding is going to be the zero line. As you see, it is always above zero, always positive. So emerging markets always provide excess returns, expected excess returns and actual excess returns to foreign investors, okay? This is what this is saying. What is interesting is the cyclicality. You see, it is very volatile and persistent at the same time. So it is not just a constant line, it moves around. However, advanced economies, the bottom, it actually holds on average. Yes, it is also moving around, but if you look at this zero line where UIP holds, on average, you can do an eyeball econometrics here, you see that it's going to be zero in advanced economies, so it holds. What is more interesting is when we look at these 2 bits of the UIP premium, the equation I showed you, remember there's an interest rate differential term, there's an exchange rate adjustment term. For emerging markets, actually, what UIP premium moves with is this interest rate differential term. That's why, as a response to contraction in the US monetary policy shock, the government bond spreads, government borrowing costs in emerging markets increase and the UIP premium increase. Whereas exchange rate adjustment term doesn't move. That's, of course, because emerging markets, most of them are managed floats. They don't let exchange rate move, right? And in advanced economies, actually, it is, the bottom figure, it's exactly the reverse. So the exchange adjustment term and the UIP premium, they are on top of each other. They are 90% correlated, whereas there is no role for the interest rate differential term in advanced economies. Both countries, emerging markets and advanced economies, UIP premium is going to move with VIX. There's going to be a very tight correlation. That's why it is going to be a very good metric to pick up these risk spillovers related to global financial conditions, the VIX. But the way it is correlated differs, right? Both countries' UIP premium is going to be correlated with VIX, but in emerging markets, that is going to feed into interest rate differential, whereas in advanced economies, that's going to feed to exchange rate adjustment. And that's exactly why flexible exchange rates are very important, as in the case of advanced economies. So what does it move with in emerging markets? Policy uncertainty. Here, what I'm plotting on the top is UIP premium in emerging markets in black, and the blue is Nick Bloom's Economy Policy Uncertainty Index extending to emerging markets. So you see there's a very tight correlation between them. And here, policy uncertainty is going to pick up things like, okay, as an emerging market central banker, you say you are an inflation target and a floating exchange rate, and you go and use your monetary policy rate to manage the exchange rate, you are going to go down in this index because your policies are not credible, okay? Because an inflation targeter floating exchange rate in emerging market cannot use monetary policy rate to manage the exchange rate. They need another tool like macroprudential policy or something else, but not monetary policy. So that's what is this economic policy uncertainty is going to capture this policy credibility. And in advanced economies, the bottom figure, you see that there is no correlation between economic policy uncertainty or the UIP premium. Okay. Now, when we come to Korea, it is clear from Mari's presentation that Korea has credible policies and floating exchange rate. In fact, Korea is now classified as an advanced country because of its high income in many classifications. But because of all these issues Korea still has with the dollar debt, with the capital flow management and all that, it is also in spirit still an emerging market. But it is, I would say, borderline, because a lot of Korea's metrics are going to respond like advanced economies, including the UIP premium, because of credible monetary policy framework and floating exchange, which is exactly why UIP premium is not going to increase in Korea as it is increasing in countries like Turkey, Argentina, Brazil, and Colombia with external shocks. So it is going to be very much like an advanced economy. And the recent integrated policy framework of the IMF, the one that Maury mentioned, actually aims to smooth UIP premium with other policies. Their objective for welfare maximizing optimal policies is UIP premium, and then the way to smooth that is they argue in their models through these counter-cyclical macroprudential policies and capital flow management policies, which become very similar when they are done counter-cyclical. And here the UIP premium response to US monetary policy shock, you see that emerging market it raises, so you pay an inefficient risk premium to foreign investors in emerging markets, not in advanced economies. Now, Korea is here. Actually, Korea's figure is exactly like the advanced economies figure, not like the emerging markets. Okay. The final thing is, it doesn't mean that even Korea with flexible exchange rate and credible policies is out of the woods. So I go back to this, vaccine issue and supply chain issue Maury mentioned. So this is from our work on making the economic case for global vaccination, which is absolutely the most important and essential thing right now. So here is a sectoral composition, how the supply chain issue is still ongoing and why we are going to get more and more of this inflationary pressure, which is going to lead Federal Reserve to tighten, which is going to then be very problematic for emerging markets because of the rising risk premium. You see the sector, we are using the global trade and production work data here, and you see that on the left, vaccinated advanced economies, they are going to be doing very well in terms of output loss. So what is plotted on the x-axis is output loss. All these sectors such as accommodation and food, arts and entertainment, they are going to have very little output loss once they are vaccinated, both in terms of tradable and non-tradable sectors. However, and I'm showing here US and Netherlands, less open and more open country, even they vaccinate everyone, because of these linkages to the emerging markets, their non-tradable sectors such as transport, storage, wholesale, and retail can have up to 10% output loss because of these breaks in the supply chain from emerging markets. Of course, emerging markets on the right is going to be much worse because they are unvaccinated, so they are going to have all the domestic cost of the pandemic and this global cost where both tradable and untradable sectors, they are color-coded, tradable blue, non-tradable pink, are going to have a lot of losses as long as this unequal vaccination stays. Okay, to conclude, basically, international risk spillovers is an important challenge for emerging market policymakers. This time-varying UIP risk premium is something that moves with all the indicators of global financial cycle, mixed policy, dollar factor, and also with economic policy uncertainty. Because there are things that you can control and there are things that you cannot as an emerging market policy maker. And you cannot just, go and control directly global financial conditions or the dollar, right? Because you are not US, you are emerging market. But you can do something about your own policy frameworks and your own policy credibility. Investors' negative sentiments on emerging markets can increase during these risk-off periods because their assessment of political risk and monetary policy credibility can go really negative on certain emerging markets if they are more risk sensitive. And that's exactly going to mean higher interest rate, higher bond spread, higher UIP premia, reduced capital flows. There is going to be a link between UIP premia and capital flows negative for emerging markets, not true for advanced economies. That makes emerging markets more risk sensitive. So in that sense, global investors expect and earn excess returns from emerging market, and this is an inefficient UIP risk premium. Okay? So the solution to this is going to be exactly as Maurice said. Flexible exchanges are going to be super important because they are going to absorb this UIP risk premium. They are going to make the trade-off for emerging market policymaker easy. So if you do procyclical monetary policy, you are going to make life worse for yourself. So if you hike when US is hiking, that's going to make the risk premium worse. Counter-cyclical policy is the right way to go, but that is going to be unfortunately ineffective without flexible exchange rates. It's going to only work with flexible exchange rate because flexible exchange rate pick up these premiums, so your counter-cyclical monetary policy can target inflation and output. Now, emerging markets, of course, are also using counter-cyclical prudential policies because they have this dollar debt problem, unhedged dollar debt problem. And if they let the exchange rate fully flexible, that means a lot of exchange rate volatility. That means a lot of problems with their dollar debt. So the trick here is not to accumulate that much dollar debt at the first place, instead of trying to deal with it in a panic move in the middle of the crisis, in the middle of the sudden stop. So you need to be doing these preemptive counter-cyclical policies to manage that effects that beforehand. And that means that for exchange volatility not to be detrimental, emerging markets need credible monetary policies and develop local financial system that is going to allow a wider range of borrowers to hedge and lenders to hedge the currency risk. And also then the credible monetary policy is going to limit the extent of pass-through from these exchange rate volatility and depreciations to inflation. So then you are going to be solving both problems by letting your exchange rate being flexible. Thank you.
Thank you, Professor Kalemi-Wazgan, for sharing your comment with us. And now I want to invite back Professor Obstfeld for the discussion on the comments or any additional points you would like further highlight.
Yeah, we're way short on time, so I would just thank Professor Shin and Professor Kalemi-Wazgan for excellent comments. And I don't have any fundamental disagreements with anything they said. So, I thank them for their complementary perspectives, both on the Korean economy and on emerging market capital inflows.
Thank you. We are almost, we are already, the time's up, so I'm sorry to say, but we are not going to take questions from the floors. And I want to wrap up this session 3. I think this session is really very useful opportunity to learn and think about and to learn how the global financial landscape has changed due to COVID-19 and what we should do after the COVID-19 period. In closing, I want to thank each one of our distinguished speaker and participants. Thank you very much.
네, 감사합니다. 지금부터 조금 시간이 많이 지나긴 지나는데요. 2시까지 저희가
Yes, we've overrun our schedule, but would like to ask that you please come back by 2 p.m. We will resume with the last session of the day at 2 p.m. Thank you.
We will now begin the last session of the day, session 4. We have two senior researchers from the KIF. As the first presenter, we have with us Mr. Bong-Sung-Koo. Please go ahead.
네, 반갑습니다. Thank you very much for this opportunity. Because in the morning session we had a very excellent presentations from global academics and also excellent discussions. My presentation is actually joint work with my colleague in the institute. And this presentation is not really about theory or empirics. Rather, it is about more policy-oriented implications. And basically, I want to review how finance industry has how our finance industry has evolved, and what is the current status of the Korean finance industry, and then probably I will identify some of the challenges. Actually, some of the challenges are already heavily discussed in the morning session, and then I will propose so-called what is the advanced model and what is the possible approaches the Korean finance industry can take in the future. Okay. As I mentioned at the start, probably Korean finance industry has been experiencing various high swings up and downs, but a very speedy recovery and solid foundations over the last 3 decades. But probably what is about the Korean finance industry is a kind of some of our successful stories after financial liberalization, especially in Asia. Also, we see this recovery or success or improvement of finance industry itself is highly related with successful growth, also globalization of the real sector in Korea. Especially even if we had some very painful experience in 1997, but after that we have taken very strong policies in every areas, not just in finance industry, but also real sector, through the restructuring, consolidations, or policy reforms. But probably in the audiences, also in the YouTube channels, we see a lot of some negative evaluations of Korean finance industry in terms of how it's not equally developed up to the real real sector. For example, maybe electronic industry. But so I see this gap must be reduced or eliminated in the future. So what is the possible path the Korean finance industry can take to remove these gaps, and how the Korean finance industry can contribute to the future of the Korean economy. So basically our idea is to be global, also to be advanced market. Even if the advanced market is not identified very clearly, but we see that when we say advanced market is similar to the United States or Japan or maybe Europe or maybe Singapore or Australia. So we see that some global comparisons with the leading financial industries globally and later. And finally, I will give some of what kind of policy agendas we can take, and 3 areas, and 4 characteristics, and the possible target in the end. Clearly, we see if you go back to 30 years ago or 40 years ago, we have quite dramatic changes in the financial liberalizations, but it did not succeed. We had a large crisis. But after that, we have a very heavy-weighted structural reforms in every area, as I said. That structural reform has been very successful somehow. The basic underlying principle, we suppose, is taking global standards more quickly, more effectively into the Korean finance industry as a practice, as a behavior or culture or management or sometimes regulations. So that was a very successful. I see even if we had some small crises in small businesses or savings bank or sometimes credit card, but still we had a very solid growth patterns. So after that, we had to see strong the institutional arrangements. For example, deposit insurance and the foreign reserves. And if you see on the right side, there's Bldg shows how Korean financial market has been stabilizing over time. So I think we have evaluated the Korean financial market has gained quite a strong resilience. The second one is probably we have to take more open policies being to the global investors. There is some small sliding trend, but still we have a large proportion of foreign ownership. Also, we had very strong participations from global financial institutions over the time. But slightly, we had a slowing trend in FDIs, but we see it quite a strong attractiveness for the foreign investors. Also, we see the banking sector, how the main finance industry has changed. We see the very high capital adequacy. Also, the soundness itself has been very good. If you see the non-performing loan ratios, it's really global bottom, I suppose. This kind of trend is not just confined to the banking sector. As the regulators or policymakers has been stressing on the capital adequacy and soundness. So that was been very widespread in other sectors as well, non-banking as well, including savings banks, I suppose. That is a slide of the, sorry, oh dear. Oh dear. Whoa. Okay, I'm sorry, I apologize. I didn't realize that. Actually, page 12. If you see, actually, the financial penetrations, for example, the asset size of the finance industry to the GDP is quite now is 200%, which is not quite small, which is quite comparable to the other countries as well. Also, if you see the market capitalization is quite high. Also, recently after the COVID crisis, it seems to be going up and again. But on the other hand, the macroeconomic contribution of finance industry a little bit lowered. Because of this kind of contributions, it depends on the profitability of the financial institutions, lower interest rate, probably lower interest margin. That is contributed slowing the financial contributions of finance industry to the GDP. Also, the Korean finance industry, we see the large growth of the non-banking sectors. For example, on the right-hand side, the non-banking sectors loans is now half of the banking sector. So, as in the early morning and morning session, some of them argued that probably the risk area, vulnerable areas could be coming from non-banking sectors. But in terms of, as I earlier showed, the overall resiliency or overall soundness of the non-banking sectors in Korea are quite sound, as far as I know, up to now. Also, if you see that the other sectors, other sectors than the banks, there's a lot of penetrations into the other financial services as well. For example, securities companies, also life insurances, also, as I mentioned, the savings banks or mutual finances, cooperative financials. So basically, financial penetration is quite showing very diffusive patterns, so which is quite signs of the fast penetrations of financial service industry in Korea. Also, the capitalization of the banks or other non-bank institutions quite strong. The last 20 years has been the capital basis of the financial institutions grow 2 times. So it's quite consistent patterns in terms of risk management, also the sound management. And even if we can't really explain all of these changes into one word, but we see lots of changes in cultural management and the governances, all sorts of things has been improved and moving faster toward the advanced market model. In terms of market structure, we see the banking sector has been very stagnant, but that is coming from the strong, massive restructuring of the financial crisis in 1997. But I think this is a stagnant market structure can prevent some dynamics in the financial market. We see more entries and exits that can be helpful for providing new services, new products. But as far as I know, banking sector has been very stagnant in terms of market structure. Also, the debt credit leverage is quite high because of it means the Korean financial market has been pursuing somehow debt-driven growth, which is very similar to any emerging market. Even if we say emerging market, we are not, Korean financial industry is not going to be like some of our very underdeveloped countries, but still our country's financial market is treated as an emerging market, even emerging being developed market. So if you see the lots of growth in financial services is driven by the debt somehow, which is also highly related to the real estate and especially housing finances, which is kind of maybe it could be vulnerable factors in the future. So our evaluation very simple. We see the strong resilience in the Korean financial industry. But we see we have to take a more dynamic approach to financial service sectors in terms of policy. But rising leverages could be some problems in the end. All the problems is going to be tackled effectively. And what is challenges Korean finance market is going to face? But a lot of challenges already mentioned in the early morning sessions. I think we see the very similar patterns what the advanced market is now facing or trying to solve. First, we see the low growth, low interest rate, or low volatilities. But also we see, particularly in Korea, it has been growing in terms of export. So it means we have more external vulnerabilities. When the global market has been hit by some risk, probably Korean economy also has been under its influence very high. So this is somehow challenging. So how export growth-driven economy can be changed into some kind of consumption-driven growth or other things, we don't know. Also, we see the loss of unemployment ratios. Oh, sorry. Oh, sorry. Okay. sorry. 좀 눌렀는데. Okay. Young user. Yeah. Okay. Yeah. Okay. See, there's some same issues anyway. Young generation unemployment is a very, very global problem, but also our countries is facing. Social challenges is more similar: aging society and low fertility rate, also larging social welfare budget. So it's kind of like the current economy is moving to more advanced economy. Whether it is good or is bad, but we see the similarity is quite high. Also, we see that some of our inequalities are growing. Probably there's lots of discussions about the financial digitalization. Well, the digitalization is going to be innovative, was competitive, probably open. So we see this is maybe a good chance for using these digitalizations into the new framework or future framework Korean finance services. So this is quite a good news, but somehow to existing institutions, this can be challenging. So in terms of policies, how to embrace these challenges, changes, transformation into the new competitive, to improve competitiveness is also another task for us. So what is the challenges about the Korean finance industry face? Probably we see the more players to be included in the financial market. Also, we see the more dynamic market structures to improve or to improve our services. Also, we do some sort of other measures to stabilize our finance systems, probably to reduce the impact of the external vulnerabilities in the future. It will be more critical, after all. These are all the same ideas. So as I already mentioned, our propositions how to be advanced market, how to be regarded as an advanced market. So we did some global benchmark to test our hypotheses. First, we took 8 countries. If you're really looking at the country, there's some, in terms of GDP, there are some countries are bigger than Korea, much bigger than Korea, but some countries are smaller than Korea. So why we do this country? Not just the quantity. We see there's some high priority. We took some countries because they took a very strong, consistent financial policies over the last 20 years, and also to be recognized as an advanced market like Singapore or maybe Australia, so even Holland. So it is arbitrarily chosen. But if you're looking at the G20 countries, it's very difficult to find our benchmark, other than this big in Germany or United States, the UK, these big countries. So to mix up, so we took 8 countries. First, we took some compare the major indicators, GDP, financial assets, and foreign assets. Clearly, you see the advanced market accumulated very high financial and foreign assets. These are all, one is Korea, all normalized numbers in Korea, thus it shows multiples. Even if the U.S. economy has been highly indebted to the foreign investors, but the GDP and foreign asset, financials are quite higher than that quite. Also, if you see that Japan, Germany, or Holland, they do have a very high level of the financial asset compared to Korea. Second one is we see some industrial perspective because we have limited the data availability of R&D of GDP. We see Korea is very high R&D expenditures, but domestically we argue that R&D seems to be quite effective. We do not really allow some failures. Probably we are too effective. But anyway, if you're looking at the United States, even if they are very advanced, low growth, but still very high expenditures on GDP up to the R&D expenditures of GDP. Also, we see the top 10 firms in terms of market capitalization. We see the graph is really clearly shows the actual landscape. But if you see, because of this high market capitalization of United States companies, but we see that some Korean, the more advanced market has been more diversified industrial portfolios. Also, they do have a very high capabilities in financial, also even manufacturing. So we see interpret this as a co-movement of the real and financial sector. It means to be a more advanced market, we see we have to be to financial services also grow or develop as much as the real sector. The third one is our resilience perspective. If you see the government debt to GDP, Korea is very low, relatively. Financial reserves, quite GDP is quite in the middle ground. But if you Japan and Singapore, probably they have much more higher reserves of GDP. So it means even we have a very high financial reserve, but still we have to go ahead to be comparable to Singapore or Japan. Other countries are very often more hard currency countries, so they do not really need for the financial FX reserves very much, as much as Korea. Foreign asset, foreign debt is quite, Korea has been very conspicuous changes. If you're looking at the actual foreign asset, Korea is becoming credit country over the last 30 years. But still, if you're looking at Japan, probably Singapore, sorry, it's not Singapore, Japan, we have more foreign assets, foreign debt, which is quite, but is comparable. But I'll argue that we need more foreign assets in the end. Other things, the finance perspective, we see the banking asset is much higher than Korea. Life insurance especially much higher than Korea. Probably historically, other country has been developing quite a long time. Our country has been just started last 30 years. So probably that kind of accumulation effect is quite there is some accumulation effect there. Also, its market capital is slightly less than other countries. So it means we need more transformation, more improvement in the real market or corporate sectors as well. On the left-hand side, bottom figure, it shows it's but very a country's comparisons, but we see the more corporate finances as advanced countries. So we see we need more. The financial service industry should move to the more corporate services from the consumer services. This is a social issues, but socially, more or less, just Korea is more or less advanced countries. High age rate, high on young employment. But if you see the private pensions, we are very small compared to like Holland or Australia or United States or Canada. So we see the more pensionable assets are quite needed for the advancing the financial services. So our interpretation from a country's comparison, one is Asian model has more foreign assets that may be driven by the too strong need for the macroeconomic resiliencies. Also, we see the more industrial enhancement, more diversified. So we need more effective services for corporate sectors. And then probably financial deepening, still we have to go ahead. Even if we have we have some problems of that, but still how can deepen the financial market into the new model, where this probably we have to move from that to probably assets. So we need more financial deepening, not just from that, but probably from other things other than that. So future agenda, we suggest some more progress approach. What is progress? We need more. We need some regime change after. We can't be concentrated on debt-driven growth. We have to more move to the asset side. Second, if we want to be an advanced market, we need more intrinsic risk management in terms of institutionalizations or other safeguards in financial system. And so we need a more stronger institutional arrangement. Even if our institutional arrangement is quite kept a very high standard, but still we have to go more stronger standard, which may be negative impact, may have negative effects on the financial performances of individual financial institutions. But in terms of macro management, we need a stronger, much stronger institutional arrangements there. So to be advanced market, we had two ideas. One is how to keep the macro resilience. Second one, how to reposition the intermediate roles of the Korean finance institutions or finance services as a whole. So I suggest 4 areas. First one is we should be more global. It means not just our service to be global, but we have to more use the global assets into the services. The second, we need more prudent in managing consumer services. So, for example, we have to more strengthen stability conditions. Also, we have to more diverse service to the corporates. Also, we see the more financial asset focus. Our service is too much driven by the debt services, but now we have to move to more asset services, asset management service. Also, it should be included some global assets, and when we say financial asset management services. Fourth one is we have to be more progressive in terms of taking risk. Probably we have to go to be more advanced market in terms of corporate sectors or manufacturing or service sectors, which to take more risk. To take a risk, we need a more stronger institutional resilience framework. So in a sense, this is kind of a high risk, high return, but we need more stronger resilience. So this framework will be more different from what we have now. We propose 3 agendas, but it's not detailed, but very just directions. We see more comprehensive market reforms. So it is just focusing on the competition and also more broader services, also more relation-based services. So which is, for example, we have a more commercializing process or shareholder financialism, so-called, or financial capitalism. But we have to be more different ideas. We have to incorporate different ideas like ESG or green finance. This is more different views. So to take this kind of diverse motivations of financial services, we have to be more targeted approaches. So it means financial institutions take their own segmented market or more targeted market. Also, they have to stick to their mandates rather than to be just commercialized or shareholder-driven and value creations. So we see the more social issues, more environmental issues, governance issues should be fully included into their decision-making. Second agenda is to be a more systematic level. We propose more three framework: regionalist framework, global framework, and crisis prevention framework. Regionalist framework is making more financial policy to be more driven on stability issues. So policy coordination between different policymakers. So this is more general framework. Second one is to make a more Korean financial market open to global market. Also, Korea financial to be more globalized, asset management more globalized, especially public, private funds, all should be more globalized, managed on global basis, more global basis. Basically, what is going to be the key issues if you want to be advanced market? How to effectively overcome crisis. We cannot exclude crisis. Crisis can happen internally or externally. So we have the more stronger crisis management framework. For instance, we have to tighten sci-fi regulation furthermore. Also, for example, we have to also use effectively regional planning, etc. So also we have a deposit guarantee plan, all this kind of standard on this, all the safeguards should be strengthened or should be strengthened. Third one is how to incorporate these socio-economic rules. So we have most of our financial institutions are really following the banking model, but probably regional institutions or cooperative institutions should take their more move to their own roles previously they had, like regional institutions serve more regional customers, also cooperative customers, more to be based on the cooperative functionings. So for their members, also the stakeholders. So to do that, we need some different regulatory framework. We can't take just a single regulatory framework. We have a more diverse regulatory framework. So this is my conclusion. Probably some of the ideas are very scratch, but also my presentation. This presentation is about somehow it can be interpreted as just great wish rather than reality. Because I think this is a really good time for young financial institutions or market participants to be how to be a advanced market, and how to be a globalized, how to be remove the gaps between the real sector and the financial sector in Korea. Thank you.
Thank you very much for the presentation. I would like to ask the moderator and the discussants to please come forward. Yes, Dr. Gu, if you could also join our panel.
Good afternoon. I am Chung Ho-seo. I'm a senior research fellow in Korea Institute of Finance. First of all, thank you very much for excellent presentation. I think even though this issue is pretty much high level, I think Dr. Gu delivered a wide range of issues in a very effective and efficient way. I think as you know, the session 4 is titled "The Future of Korean Financial Industry," And Dr. Gu told about how Korea's financial industry has been developed and should play its role in the future. And I think we have a lot of things to discuss later on. Before going to the discussion, let me briefly introduce the session speaker and the discussant. First of all, Dr. Gu is a senior research fellow at the Korea Institute of Finance since 2007. Prior to joining the KIF, he worked for Anderson Consulting in the area of strategy and financial services from 2002 to 2004 upon earning his doctorate from the University of York in UK. His research interests are mostly in policy issues in financial services sector. Recently, he's interested in the regulation of digital finance and its long-term implications on the Korean financial industry. And discussant, Dr. Yeo, Professor Yeo, is a professor of finance at the Jungang University Business School. She received her bachelor's and master's degrees in chemical engineering from Seoul National University. She graduated from the University of Michigan, Ann Arbor, with her PhD in economics. Professor Yeo's academic interest lies at the intersection of corporate finance and industrial organization, both theoretically and empirically. Her research has explored the fintech, corporate finance, financial intermediation, and financial markets. Without further ado, please welcome discussant Professor Yeo.
Thank you for giving me a great opportunity. Actually, I think Dr. Gu's presentation is well organized, and he mentioned many challenges in the Korean financial industry, and he actually suggested many good policy implications. So firstly, let me briefly summarize what he mentioned in his presentation. So current status of the Korean financial industry, hence after I call KFI. For the last 20 years in KFI, we've observed quantitative growth in all type of financial assets and market capitalization. And at the same time, there was an improvement in macroprudence and micro-resilience. However, we also observed such as increased concentration and homogenization as an industry like banking industry or securities companies industry. At the same time, a rapid increase in household debt, and as a result, banks were exposed to the high risk in the real estate. And interestingly, the financial industry contribute limitedly to the growth of the economy. And the second part is some challenges of KFI. So he actually mentioned from the three perspectives. So the first one is economic perspective. As everybody knows that the economy is aging rapidly. And at the same time, as maybe the speed of aging is the highest in the world. Even it's higher than Japan, I think. And also, our economy depends too much on export. And so the old formula for growth does not work anymore. Unfortunately, no quick fix is in hand. And the second perspective is institutional. So public pension funds like NPS play some roles in the market, but there are limitations. So we say the problem is weak institutional investors. And the third perspective is technological. So everybody knows that the tech development is rapid and there are some big challenges from non-financial tech firms, so-called fintech firms and the big tech firms. So spread of payment services by fintech firms, and as a result, there's a decrease in financial core deposit, and maybe big tech firms can run the table. And the third summary, and he actually, Dr. Gu proposed 3 agendas. First one is value creation, and it includes objectives of globalization of asset management services. And every company actually should adopt technological innovation, such as AI or big data analysis immediately. And the second one is market reform. And it includes objectives such as deregulation that facilitate diversification and globalization. And also, he emphasized that the crisis prevention, the financial crisis should be prevented by tighter regulation of CFI and enhanced deposit guarantee and resolution funds. The third was the socio-economic integration. Then it includes objectives like more emphasis on ESG investment and also financial inclusion. Let me elaborate one thing here. Then, as you know that this graph, actually, this picture illustrates the change in retail finance. So it used to be the vertical, but now it becomes horizontal. More and more retail consumers have access to their financial services via financial platform like Naver or Kakao. Then those are all big tech firms. It means that the structure of financial service turns horizontal. And the vertical regulation that used to be in the past, this regime becomes practically meaningless. And then here's let me try to mention a few things. Then actually all of our goals that Dr. Gu mentioned are of course important. But if not many, some of them are very hard to achieve at the same time. That's why I actually put the title like this, Between a Rock and a Hard Place. So simply speaking, we need to set and keep the balance between 2 countering goals. First one, for example, efficiency and openness versus prudence and resilience. So, for example, like the emergence of fintech has forced Korea to tilt toward the former, means efficiency enhanced and more openness. But the legacy of the past still plays some role in choosing between the balance. So, for example, the role of shadow regulations, such as the verbal instructions or verbal guidelines from regulation authority has played a significant role in prudence regulation. Then, what's the role of the shadow regulation in the future? What should we do with it? Better not completely remove it, but we may need to do it in a different approach. And another important but difficult task is financial deepening or financial inclusion. So unfortunately, there's no consensus about its effect on the balance between efficiency and the systemic risk yet. It may possibly be another goal of finance in the future, but more research should be done. And also, financial deepening or inclusive finance need to be a complement to the fiscal policy, not a substitute. And here is the complicated relations. So let me mention some of the challenges are interlinked among them in a good or in a bad way. For example, rapid climate change and population decrease are two big eminent challenges. That's true. But both are catastrophic events, that's true, but their effects somehow counter against each other. And another example is the fact of common share ownership. In other words, overlapping share ownership. So the growing ownership, common ownership of large and diversified institutional investors, such as pension funds, in a wide range of major industry may hamper competition. There is an interesting empirical evidence that it shows that high common ownership or high overlapping share ownership is associated with high prices. For example, simply that the NPS hold the shares of Samsung Electronics, at the same time it holds the shares of SK Hynix. Those are rivals in the same industry. Then as a result, competition deteriorated. So it is called like modern day antitrust blind spot, according to the Baker 2016. Lastly, it is a similar the topic, but then it is more theoretical analysis. Jose Ezor published his paper in 2020. Then it is impossible to achieve the following objectives simultaneously. First one is portfolio diversification. Second one is shareholder representation. Third one is competition. So he shows that theoretically, the satisfaction of portfolio diversification and shareholder representation leads to economic-wide monopoly. And if this is true, then do we need to put some restriction on the common share ownership by large institutional investors to facilitate competition? Maybe or maybe not. So more research should be done in this category. That's it. Thank you very much.
Okay, thank you. Thank you very much. Okay. I wouldn't summarize her comments, her discussion, but I feel like we exposed all of our pain points to the public. Since we have since we almost ran out of time, I want to solicit only one question from the floor. So if you have a question, please raise your hand. Okay, if there's no question, I'm gonna finish up this session. Thank you very much. Okay.
We will now move on to the second presentation of session 4. I would like to invite Senior Research Fellow of KIF, Dr. Chang Min.
Thank you. Thank you for having me here. And thank you for keeping your seat till the last session of today. I think you are very tired. It's a big pleasure for me to participate in the international seminar for 30th anniversary of KIF, which is my job place. And then, and also it is a great pleasure to be with the very honorable scholars and guests today. My topic I want to present today is Korea's potential growth path in post-pandemic era. And Dr. Sung-wook Park and I wrote this paper together a few months ago. And our goal was to estimate Korea's future growth path under different conditions. Considering COVID-19 has brought a lot of structural changes economically and socially, we think that this study can give us a glimpse idea about what we should do to maintain a stable growth in Korea. So let me start with giving you a snapshot of a Korean economy. This slide shows that how Korean economy has developed for the last 40 years. As you can see in the graph at the bottom, the average growth rate and the trend growth rate have decreased by 2% point every decade since the 1970s. From 1970s to 1990s, like in 1970s, the average growth rate was about 10%, and also the trend growth rate was about 10%. But 40 years later, in these days, from 2010 to 2019, the average growth rate dropped to like 3% level, and trend growth rate is about 2% level. Actually, we believe that these days, potential growth rate in these days is only mere 2%, as Bank of Korea has already has studies there. So to make things worse, going through the COVID-19, Korea's economic growth rate plummeted, and that level has increased sharply. As you can see the graph, the left picture, Korea's household debt has increased by more than 30% point during the pandemic years, much higher and faster than any other countries. As a result, Korea is the only country which the household debt GDP growth rate and DSR growth rate both are at highest level among the OECD countries these days. So I think we all know that the strong perception, we have a very strong perception that COVID-19 affect the current growth rate as well as a potential growth rate in many countries. And Korea will be no exception. So it means that the downtrend may accelerate if the Korean economy fails to effectively cope with the changes in social and economic landscape of a post-pandemic era, such as rapid digitalization and a global spread of regionalism. Therefore, Korea needs to maintain its capital, labor, and productivity at an adequate level in order to secure a stable growth trend. And to get an idea of what are the possible growth paths in future for Korean economy, we set various assumptions on every product factors, and we estimate the potential growth rate of Korea depending on these scenarios of how effectively it responds to social and economic changes. The scenarios project the growth path of capital, labor, and productivity until the year of 2014-5. So I'd like to skip this part because I think you are very well aware of methodologies for estimating potential growth rate. And I just to let you know that we took a production function approach, which is much popular in these areas. And we set some numbers, and the labor income share and the labor input. This slide shows which statistics we have used for this paper. And so let me explain what is our assumptions. To estimate Korea's future potential growth rate, we applied 3 different scenarios to each product factors. First, the neutral scenario means that the labor and the capital growth rate remains at the current level and the productivity converges to the middle level of OECD countries over the next 10 years. And positive scenarios in general, it means that all factors gradually converge to the level of a top group of OECD countries in over the next 10 years. And contrarily, the negative scenario means that all factors gradually converge to the bottom level of OECD countries through the next 10 years. Although there are some detailed scenarios are a little bit different each by each. But in general, our setting is like neutral is like we maintain the current level for next 10 years. And the positive scenario means that we upgrade to the high level of the top level of OECD countries in 3 sectors. And the negative scenario means that we drop to like a bottom level of OECD countries over the next 10 years. So I'd like to show that in which path we take, then how our growth rate will move. So let me explain the result of a neutral scenario first. In the case of a neutral scenario where growth rates of capital, labor, and productivity maintain the current levels, Korea's potential growth rate of 2% in 2020 will fall to around 1% in 2030 and to 0.6% in 2045. This is because the labor contribution rate will turn negative from around 2026 because of shrinking the labor forces. Then start with some 2 different scenarios about the capital growth rate. In this positive scenario for capital growth rate, it means that if capital growth rate converges to the top level of OECD countries over the next 10 years, then Korea's potential growth rate will maintain its level at high 1% in 2030s and mid 1% in 2045. It means that the positive scenario for capital means that all other factors like labor, productivity follow the neutral scenarios. The only positive scenario only apply to the capital growth. And this result because the capital increases to a level that sufficiently offset the negative effect of labor, as you can see in the graph on the right-hand side. But in the other hand, if the total capital accumulation slows down in response to population decline, it means that it does not increase with the population. Korea's potential growth rate will drop to 2% range in 2020 to mid 0% in 2030 and around minus 0.1% in 2045. It means that because the effect of labor reduction becomes critical as the capital contribution rate gradually converges to 0. Let's move to the labor part. This slide shows the result of a positive scenario for labor growth rate. Here, if female labor force participation rate rises to the top level of OECD countries, while the female population starts to outnumber the male population from around 2028, Korea's potential growth rate will remain at 2% even until the late 2020s. Because this is the growth of female labor force participation will help labor contribution rate to remain at the positive level until 2030, when the female labor force participation rate rises. So if you see the graph on the left-hand side, then the labor, the growth is like keep the positive until the 2030s. And on the other hand, if the proportion of women and elderly population increases while their labor force participation rate remains at the current level, Korea's potential growth rate will drop to the range of a high 0% in 2030 and to around 0.5% in 2045. But since the effect of a demographic change is very marginal, so the potential growth rate follows the similar path to the neutral scenarios. Next, the productivity. In the positive scenario, if the productivity growth rate converges to the top level of OECD countries over the next 10 years, then Korea's potential growth rate will maintain its level at mid or high 1% in 2030 and the low 1% in 2045. This is because the effect of increasing productivity outweighs the effect of decreasing labor. However, if a productivity growth rate converges to the bottom level of OECD countries over the next 10 years, then Korea's potential growth rate will drop to mid 0% in 2030 and to around 0% in 2045. So since the contribution of productivity will fall to the level of 0% from the mid-2020s. And this slide contrasts the result of optimistic scenario with that of a pessimistic scenario. Optimistic scenario means that all factors, labor, capital, and productivity, follow the positive scenarios, while pessimistic ones means that all factors follow the negative scenarios. So in the case of an optimistic scenario, then Korea's potential growth rate will maintain its level at mid 2% in 2030 and the low 2% even in 2045. However, under the pessimistic scenario, where all production factors follow the negative scenarios, Korea's potential growth rate dropped to low 0% in 2030 and to around minus 0.5% in 2045. So you can see the potential growth rate is dropped very sharply in the pessimistic scenario, the right-hand side. Then let's compare the size of GDP by scenario. According to the optimistic scenario, Korea continued to maintain a 2% potential growth rate even until the 2040s, which will make up as a 1.5 times bigger economy than that according to the neutral scenario. So if we jump up to the top level of OECD countries in every aspect of labor, capital, and productivity, then our economy size could be much, much bigger than the neutral scenario. However, if Korea follows the pessimistic scenario, then it means that the GDP size will be only 80% of a neutral scenario. It means that if we follow the optimistic scenario and then the economy size is about double as the pessimistic scenario. Then I think what is important is that which path Korea will follow, but although we have no ideas about that yet. But so looking backward, we did the same exercise. Assume that we are in 1995. And we take the same three assumptions, three scenarios, and do same exercise for next 20 years, from 1995 to 2015, with only the information we have in 1995. So this is then we found that Korea's actual growth rate was very similar to the potential growth path estimated under the assumption that each production factor converged to the middle level of OECD countries over 20 years, which is a very a neutral scenario we took for the studyings for estimating for future potential growth rate. But very surprisingly, if you see the right-hand side of graph, then it means that the real Korea's growth is it's a blue line. It's very similar though. It's with the red line, which is the benchmark scenario. It means that Korea followed the neutral scenario for less than 20 years. But this does not mean that Korea will show will get the same outcome as in future. So we could jump up to the high level of OECD countries, or we could drop to like a low level of OECD countries at any time. So then what should we do for stable growth? Well, there are lots of arguments and lots of discussions about this area, but I want to leave discussion as open the topic for discussion and for floor today. But I'd like to conclude my presentation by emphasizing that given the decline in potential growth rate, the result of accumulated effect of change in socio-economic structure over a long time, so government policies for gradual improvement in the overall structure will be needed. And then I think Professor Zhang will give us a very deeper discussion about this area. And yeah, thank you for your time and attention. Thank you.
네, 감사합니다. 잠시 자리 정리하고 사회자분과 토론자분 앞으로 나오시겠습니다.
Okay, thank you very much for the presentation. I think it's very interesting and very intuitive. Before we move on, let me briefly introduce the session speaker and discussant. Okay. Dr. Min Chang, today's presenter, is a senior research fellow at the Korea Institute of Finance. His previous positions include the Director General of Research Department at the Bank of Korea, Director of Research at the KIF, Senior Advisor to the Chairman of Financial Services Commission, Head of Macroeconomic Research Division at the KIF. He worked at the Bank of Korea, which is a central bank, during the period between 1990 and 2008, where he held a number of key positions, including Director of Monetary Policy Department. He also served as a visiting economist at the Bank for International Settlement. He received his PhD in economics from Michigan State University and his BA in economics from Seoul National University. And today's discussant, Professor Yong-Sung Chang, is a professor of Seoul National University. He is a macroeconomist who specializes in economic fluctuations and the labor market dynamics. He obtained his PhD in economics from the University of Rochester in 1997. He held positions at the University of Pennsylvania, University of Rochester, and the Yonsei University in Korea. He also worked for the Federal Reserve Bank of Richmond as a senior economist. He has published more than 20 research articles in top-tier academic journals, such as American Economic Review, Review of Economic Studies, Journal of Monetary Economics, and so on. He is currently an associate editor of the Journal of Monetary Economics, the advisory board member of the Carnegie Rochester Conference Series on Public Policy, and editor of Korea Economic Review. Without further ado, I'm going to ask Dr. Zhang to make a discussion about Dr. Zhang's presentation.
Thank you. First of all, it's a great honor and pleasure to be a part of this anniversary conference. I'd like to congratulate KIF for becoming the best research institute in Korea in 30 years. And also I would like to thank organizers for giving me a chance to discuss this interesting paper by Dr. Chang and Dr. Park. So since Dr. Chang gave a very nice summary of the result, so I'm not going to repeat all, but just mention that as you saw, the authors forecast long-term growth rate of Korea for the next 2 decades using essentially 9 scenarios, so 3 scenarios of each factors, capital, labor, and TFP. And then, as you saw, we grew like China in 1970s, but now its growth rate is only about 2%. So according to the authors, if I take the most optimistic scenario, which is red here, still it's only about 33% or maybe 2.5% of GDP growth. And if I take the benchmark case, which is neutral scenario, it still goes down to 1% or 0.5%. And then if I hope we go there, but if we follow the pessimistic scenario, then we go to negative growth rate, so the economy will shrink over time. So long-term forecast, why we do this? It's very important because a lot of government policies will based on the forecast. And also knowing the sources of stagnation may provide us a maybe clue to reboost economic growth. So I think it's a very reasonable scenarios in each case, and then in the end they provide a very useful guideline for the projection of future economy. So this result will be used by government policymakers and also private sectors down the road. And I would like to comment on a few areas of potential sources of economic growth, if I can. Just based on some earlier works on reallocation, which I will mention in a minute. So I'd like to mention labor, capital, and TFP, because all 3 factors provide us a kind of gloomy picture for the next 2 decades. So for the labor input, I guess the biggest challenge we face is the aging population, as the authors pointed out. So maybe how do we maybe mitigate or overcome this? So I listed a few things: women, maybe young, maybe immigrants. And then if we cannot increase the quantity, maybe we have to do something with the quality. I was going to mention North Korea here. So if the peace process is going well, maybe we could use labor force in North Korea. But then one of my colleagues who is expert in North Korean economy said, oh, no, I don't think, he doesn't think they can be really used right away because they don't know how to work in market economy and so on. So he was very pessimistic. So I just decided not to put in here anyway. So here's the elderly map of world map of elderly published by United Nations. So this is 2000. If you see, the blue area is a country where the population over age 65 or older make up about 15% or higher. So only Western European countries, maybe some Eastern European countries, and Japan have this blue. But then if we move forward 2050, then even China, you see the more than 30% population are over age 65. So Korea is the fastest aging country in the world, but soon China will be the fastest aging country in the world. So it's not just us, it's everywhere. Now, I guess people provide a lot of pessimistic outlook based on this aging population, but I guess maybe we are too pessimistic too. Maybe as Malthus was pessimistic about population and economic growth. So United Nations dependence ratio is considered age 65 as dependent. But nowadays, if you look at people at age 65, they are very active and healthy. Maybe perhaps we are too pessimistic. And then as Malthus was wrong in predicting the future, maybe we hope that the economy will find a way to respond to this new changes or to fast changing population aging. And the old historian Vogel, according to his remarkable research, 1/3 of per capita income growth in Britain between 1790 to 1980 was actually due to improved nutrition. So people got healthier, and that actually produced, that can account for about 1/3 of per capita economic growth in Britain. So maybe as we get healthier, this may be a source of potential growth in the future if we can take advantage of it. So maybe if there are ways to utilize healthy elderly, then I guess that might be a way to slow down the economic slowdown. So then the next question, issue is women. So we all know that there's a fast increase in female labor supply. Now, if you look at many OECD countries, their participation rate is now as high as men. And I guess the key is, if we talk to labor economists, find a way to not to interrupt their career path, because if they have to give birth and then they have to raise children, they stop working. But when they try to come back, it's hard to come back with the same level of productivity and so on. So probably we have to think about, is there any way to not to interrupt their career path? So this is a kind of hours age profile in the US from CPS. So each line is a cohort. So I'm going to tell you what cohort means. So this is men. So this is about, this is women. So if you look at the bottom one, which is a cohort who were born 1866 to 1875, probably nobody is alive in this cohort. So you see they actually stopped working. They started working at the age of 20, but then immediately they stop working because they have to have children and raise children, and they don't come back. But if you look at the top one, which is a cohort of 1976 to who were born in 1976, 1985, their profile is just like men. So you cannot really distinguish women's profile from men's profile. Okay? So if this continues, I guess women may be the hope for the maintaining the labor force. The next one is young. It is not just Korea. It's all over the places where we see the high unemployment rates of young. So people talk about mismatch, the technological change, and then the skill level. One thing we have to also think about is, especially in Korea, the young generation, they are really rich in the sense that much wealthier than previous generations. So their labor supply behavior is very different. And then there's an interesting paper by Agia, Bills, and Charles and Hurst, JP 2021. What they found was there's an enormous increased time spent on computer games among young people, especially poor young people, black population especially. So what the implication is that, their implication is that as long as they can afford computer games and Netflix, they are happy. They don't have much ambition to, let's say, I want to be rich, I want to have a yacht and maybe a huge house and so on. So there's a kind of significant fraction of young people who are happy with playing computer games. So their labor supply is quite different from a previous generation. And then it's not in the published version, but in the working paper version, they had this graph where countries with fast decline in price of computer games, which was Korea and Japan, has shown the most rapid increase in the unemployment rate among young. So the next one is immigration. So if you look at the rural area of Korea, 3 out of 10 marriages are actually international marriages nowadays. So it's amazing how many international marriages are in rural area. Yet Korea, we don't think Korea is a very open society to non-Korean. So can you imagine a second generation immigrant become a president of the country or a CEO of like top corporation in Korea? I don't think so yet. But if you look at US, Obama, Steve Jobs, they are all second generation immigrants. So we need immigration policy, not just the unskilled workers. We have to think about, can we attract really brilliant people from all over the world? And then quality of labor, I mean, education system, I don't want to talk about this. You can go along forever. And then there's a recent study by my colleagues at Seoul National, Jebin An and Seji Kim. They find that slowdown of human capital accumulation is a major source of declining growth of Korea. And this is Kim's law. He named it for himself. Average GDP growth falls by 1% every 5 years. Okay. And then they also pointed out that there's a structural change from manufacturing to service. So, and then we all know that service sector, the productivity is not that high in Korea, right? There are small shops, a lot of self-employment stores, and misallocation widespread in service sector, so that if the economy moving from large corporation, which is mostly manufacturing, then moving to service, then you see a productivity slowdown too. So I would like to talk about like a misallocation literature by Cheng Tae-shi and Pete Kleiner. So what they found is first, there's the structural transformation moving from agriculture, manufacturing, service. You naturally see the slowdown of investment operation because you're moving from capital-intensive manufacturing to less capital-intensive service sector. But at the same time, traditional measure of capital does not reflect intangible capital like software and so on. So just using capital or slowdown of capital may not be surprising. But then Shi and Kleiner according to Shi and Kleiner study, they have a really important, they provide an important implication of a solo residual, which is TFP. We often macroeconomists labeled TFP as a residual, but it's the most important thing, I guess. So Shi and Kleiner show that misallocation is an important source of TFP differences across countries, which is basically what they did was they compare the marginal product capital or average product capital of each establishment and see, let's just moving the resource, 1 unit of capital from productive firm to less productive firm to highly productive firm and see how much gain you will get. So according to their calculation, without adding any more capital, with the same amount of capital, China can have almost 50% higher TFP. In India, almost 60% of TFP relative to US. This is relative to US. So same logic can be applied to allocation of labor or talent. So if you just allocate a smart guy to be in charge of important stuff, then the organization, the TFP of organization will improve. So here's the firm size distribution in Shi and Kleiner, 2014. So India, Mexico, US, this x-axis is age of a firm. So you can see that there are a lot of firms in Mexico and India. It's different size. But then as age is, there are a lot of old firms in US, but then the next one shows that the firm size. So if you look at the firm size, India and Mexico firms do not grow as much as in US. So that means the economy let the firm grow. If you are really good, you can be really big in US, but as opposed to Mexico and India, even if you are good, you cannot, there's a lot of restriction on size and regulation, maybe interruption by politicians and so on. So the firms cannot grow to its potential. So then, so the Shi and Kleiner gave us a lesson that there's enormous gain in TFP by moving resources from less productive to more productive firms. Even with the same input, you can get much larger output. So then what's the other policy implication? Maybe you have to be careful about restriction on firm size. You have to avoid the cronyism and maybe the corruption and so on. So I think this is simple economics. There's nothing magic here, but maybe politically very difficult to implement. So this might be the challenge we have. So we face various challenges to economic growth. At the same time, if we are smart and if we move wisely, then maybe we can open a new era. And then if you seek for alternative supplies, high quality labor, then you have to think about maybe women, maybe old, young, and immigration, education, and misallocation. So thanks again for giving me an opportunity to read a very interesting paper, and then congratulations again to the KIF.
Thank you very much. Okay. Thank you for your discussion. I think it's equally interesting and then very intuitive. Okay. Shortly, I would like to ask questions from the floor, and the online as well. Dr. Park, so you have a question?
See you again. I don't know whether you were here in the morning to listen to Asanoglu's paper. Were you here this morning?
I was on YouTube.
YouTube, so you know what he was talking about. Yes. So what is your assessment? What is your view on his presentation? Especially the question I'd like to ask you is, what would be the impact of automation and AIE on TFP first, and then total factor productivity and potential growth rate? Because there is some sort of negative relations between the productivity, the total factor productivity increase and labor participation. So what would be your assessment? The automation and AI would contribute to the potential rate of growth or not?
I guess it's a very challenging question, so I don't think I have a good answer. But so my general perception is that people are very worried about robots taking jobs away from us. But if I look at the first, second, third industrial revolution, we were all worried. But in the end, we had more jobs. So the new technology create more jobs. In that sense, I'm more optimistic that it will take away our jobs, but then there are more and more better jobs. So that I guess in the long run, I think it might be a plus. So I cannot really predict, but I'm a little bit more optimistic about it will create more jobs in the sense that it will create more jobs.
Can you substantiate that your view, your argument?
Well, I guess as I mentioned, the same worry we had in the first revolution, in the first industrial revolution, second industrial revolution, third industrial. So in the past, 3 out of 3 we had more jobs in the end. So why is it different? Why should it be different?
Okay. Any other questions from the floor? Okay. Since we have some time, because both Professor Chang and Dr. Chang saved the time, I would like to ask one question. As you noted, the inequality issues, the gender inequality in the labor force is one of the key issues that we should resolve in raising Korea's potential growth rate. Do you have anything in mind for this issue? It is recently reported that more than 1 in 6 Korean women suffers a career break after their marriage. In Professor Chang's presentation, I saw the graph, the labor supply of women. It's kind of a big hump shape, but unlike that shape in Korea, I think Korea's that kind of graph is more like a M shape. Right? So I think it is a kind of important issue. What do you have in your mind? Okay.
You're right that we're not like this, but I think we are getting there. So in a sense that, right now we're not like this, but I guess maybe government needs to provide maybe better daycare and so on, so that women would be like this, just like men. So, so you are right that we are not close right here, but still we are in the process of moving in this direction, I guess. Yeah. For the inequality, I guess one thing that we don't really talk about dynamic inequality. We only look at Gini coefficient, which is static inequality. So Korea is equal society, more equal society than US actually. Gini coefficient is lower. But if you look at the social mobility, I think that's the primary issue that nowadays the social mobility is not that high.
Okay, thank you very much. Dr. Zhang, do you have any, you want to wrap up this session by commenting?
No, I have nothing particular in my mind. I totally agree with him, and I haven't any disagreement with his, Professor Zhang's proposal or his discussions at all. Thank you.
Okay, thank you. Thank you very much for participating in today's conference. We will wrap this session up now, so let's call it a day. Thank you very much. Okay.
Thank you very much. That brings us to the end of the Day 1 program for the conference for the 30th anniversary of the KIF. Tomorrow, we will continue on with the panel discussion in the morning. Thank you.